The market continues to make new highs.
Higher productivity supports higher valuations.
The market clearly is pricing in a decent amount of expectation for forward growth.
Let's not just focus on the expectations, but also about the market action.
You need to put your money somewhere. And the reality is the US is the only place where you can actually put scale.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, heading towards a government shutdown. The meeting with congressional leaders failing to deliver a breakthrough as the BLS is confirming this week's jobs report may well be delayed. The equity market is looking to close out Q3 with another quarterly gain. Q4 is coming right up.
And a lot of it's going to depend on the earnings. I just want to note, though, that the dissonance between Washington, D.C. and markets is pretty shocking right now. In markets, there is this feeling that Q4 will bring more earnings, more gains, a sense of euphoria around AI spreading out to the rest of the universe with Fed rate cuts on tap. In Washington, D.C., can't get anything done, and they're facing off with constituents that feel very differently because it's only a small cohort of the overall consumer base that really is feeling such euphoria that's being reflected in earnings.
Wall Street united, D.C. divided. These are the statements from Senator Schumer. It's in the president's hands. The Vice President, J.D. Vance. Democrats won't do the right thing. The blame game continues.
And I was there yesterday when they came out to the microphones to brief the press, to both basically throw stones at the other side about why they're stuck right now in this paralysis. And the vice president said it directly. I think we're headed into a shutdown. It's not a matter of if, it's how long this shutdown is going to last. Because guess what? The House is not in session. So the only way we can avoid a shutdown right now is if Senate Democrats decide to vote for that clean CR that Senate Majority Leader John Thune could put on the floor. That's not going to happen. Senate Majority Leader John Thune said yesterday those discussions were lively, they were spirited, but they resulted in no outcome, no solution. It is not if, it's for how long we're going to be shut down.
The market cares about one thing. Will we or won't we get a jobs report on Friday? So this is what the BLS has got to say. If the government shuts down, the BLS will suspend all operations and cease all active data collection activity. So Wall Street might be flying blind, kinda.
Kinda, because it's going to be ADP week. This is Make ADP Great Again week, which is what we've seen for a number of months now in terms of its import and how people trade it. What's interesting to me is, yes, the non-farm payrolls report, but then it's CPI next week. And then it's the fact that come the Fed's meeting at the end of this month, you might not have any new data. And they might have to make a decision at a time where there's an increasing consensus around cutting rates by another 25 basis points. That, to me, potentially is more interesting.
At a time when the hawks are starting to make a little bit more noise.
Yeah, exactly.
What are 24 hours? Hammock, Muslim, making their points, and the daylight between them and the Governor Mara into this world could not be wider right now.
And it's an honest and important economic debate, and it's a debate that can be had. What I keep hearing from all of the people who come on our show is right now they're betting on equity market gains. Do they think it could get excessive? Maybe. Do they think that we need rate cuts? Probably not. Are they going to ride it? Absolutely, because they are judged by how much money they make and they want to be on this train.
Max Kettner, HSBC, not getting off that train anytime soon. Equity futures on the S&P negative here by almost 0.2% as we close out September and Q3. Coming up this hour, Jay Pelosky of TPW Advisory as we close out the third quarter. Terry Haines of Pangaea Policy on the growing risk of a government shutdown. And the former White House trade advisor Kellyanne Shaw as President Trump adds a fresh round of tariffs. We begin this hour with stocks heading towards a fifth straight month of gains. Jay Pelosky of TPW Advisory writing the latest US economic data does not suggest an economy in need of multiple rate cuts. We see reflation, not recession. Jay joins us now for more. Jay, is that the view into year-end and beyond?
Yes, indeed, John, it is, because not only are we going to have reflation in the U.S., I mean, what else can you have with 6 to 7% budget deficits and a Fed cutting into 3% growth? But you also have China, the other major global economy that is reflating, right? Focused on fighting deflation and stimulating their economy. So in our view, it's very simple. You have the U.S. Stimulating, you have China stimulating, and therefore it's reflation, not recession.
Jay, give us an idea of some numbers. Just how hot are policymakers about to run this thing? Talk to me about growth, the inflation numbers. What do things look like in your mind?
Well, in the U.S., I think you have to remember that with no growth in the labor force, growth is going to be slow in terms of numbers, right? So we're seeing that already in the jobs report, right? It takes 40,000, 50,000 jobs to keep the unemployment rate around 4.3%. A year ago, 2 years ago, it was 200,000 jobs. So you have to put that into context. That's a key contextual point that we make to our clients and others as we talk about the economy. So U.S. grows at 2%. Inflation is going to run hot. That's clear. So let's call it 5%. And this is a point, John, I remember talking with you about this back in the COVID days. So that means nominal growth in the U.S. is going to run somewhere north of 5%. So you're going to have earnings growth, right? Remember, the key is that sales, revenues, and earnings are denominated in nominal dollars. So if you have 5 to 6% nominal growth, you're going to have 5 to 7% kind of natural earnings growth. Then you squeeze out a little bit more on the margins, buy back some more stock, and you have single-digit earnings growth in the U.S., and that's sufficient to keep the U.S. Stock market in decent shape. And that is the key to us anyway, because we're focused on the non-U.S. markets. Again, as you know quite well, that's been our position for well over a year now. So the key is that the best time for non-U.S. to outperform is if the U.S. is doing okay. And so we see better growth opportunities coming in Europe. We see better growth opportunities in Asia. China is going to grow at its normal 5% rate. But again, the important thing is earnings. And here, as China defeats deflation, earnings growth is going to pick up. That means multiples will pick up. That means stock prices will pick up. And that means you're going to do better in China than you would in the U.S. or other markets. So we remain very keen on China, very keen on emerging market equities, very keen on commodities as well.
I feel like the world isn't necessarily divided into regions, it's divided into sectors. How much are you focusing the international investments on tech that is ex-US versus the rest of the universe that's been left behind for the most part?
Yeah, great point, Lisa. And you know, I might disagree somewhat, but point taken. And look, again, China tech has been dominating US tech in terms of equity performance for the last 2 years. Again, we've talked about it on this show many times. K-Web is up 50% this year to date, and versus the Qs that are up, what, 10, 12%? So tech in China is a key position for us. Energy is a key position for us. We think that's the biggest opportunity right now. It's the one that Wall Street is going to get completely wrong. So we really like energy. We've been adding there. We like financials outside the U.S. Again, an old favorite. European banks continue to outperform the U.S. as they have for the last several years. You know, people are finally starting to wake up that the non-U.S. markets offer significant outperformance potential. That's been the case for 2025. I think we're in the beginning of a secular leadership change away from U.S. equities to the rest of the world, led by emerging markets, which are the big beneficiaries of a Fed cutting in a weak dollar. That allows central banks and EM to cut rates, support their growth without worrying about their currencies. And lo and behold, what have we seen this year? Bank of America points out over 100 rate cuts in emerging markets.
Jay, there's also this political overlay. At what point is it extra risky to invest in a place like China at a time where there could be some safeguards or walls put up to international investors, something that we've seen before, something that we've seen even from the U.S. in terms of certain restrictions as the relationship is increasingly fraught?
Yeah, that's a key point for us, Lisa, but we flip the script there and we focus on the opportunity that we see coming up in China. And we see that kind of risk much more in the United States under a Trump administration, right? The policy, erratic nature of policymaking is not in China, it's in the United States. And that's why the dollar is weakening as people start to protect themselves first via hedging. And then we believe over time, just letting their U.S. positions go back to a normal weighting. Right now, the world is overweight the U.S. But here's the point about China. We think the last couple weeks, Splinternet, where the China and U.S. tech stacks completely divide, has finally materialized. This is something we've been writing about for years. In the last 2 weeks, China has said their companies cannot use NVIDIA chips You've had Huawei come out and publicly state how they're going to compete with NVIDIA, which is very unusual for China tech. Usually they don't talk about that stuff. And then last week you had Alibaba come out and say they're going to join the hyperscalers and spend $50 billion on compute. And so to us, what's really significant here is that before any summit, right, Trump and Xi are going to meet at some point in Q1, not talking about South Korea at the end of the month, Q1 summit meeting in China. And we think the Chinese have sent the shot across the bow that the leverage the U.S. thinks it had with NVIDIA chips no longer holds, and that China does have leverage over the U.S. via the rare earths. And so we're looking for the exact opposite. We're looking for a rapprochement amongst China and the U.S. that will signal that China is once again investable. And so we would not be surprised at all. And the TikTok deal is an early indication of this. We would not be surprised at all that in Q1, Q2 next year, the signal is sent that for U.S. institutions, who I agree with you, are not exposed to Chinese equity in any way relative to the benchmark weight, are given the signal that it now is okay to buy China again. And that's going to set off the next leg of Chinese outperformance versus the U.S.
Jay, domestically, we're about to have a government shutdown. Does this matter at all to financial markets?
Nope.
Even though we might not get the jobs report on Friday?
No, not really. Again, I think people are understanding that the job market is in flux due to the labor numbers, and therefore the focus is going to shift right away to earnings. That might be convenient for the market, right? We're going to talk about earnings for the next couple of weeks. They're going to be okay, et cetera. I do think if we still have a shutdown by the end of the month, it could impact the Fed meeting, and that might be, a reason for people to pull back a little bit here. But in essence, again, Annmarie, you and I have talked about this. Our view has been basically for the last 8 months to pay zero attention to what this administration says. We focus on what it does, and what it does, it's already done, which is namely ensure that we're going to have fiscal deficits of 6 or 7% as far as we can see. And we are now politicizing the Fed such that we know the Fed is going to run the economy hot, and the market doesn't need to know anything more than that.
Record highs, just about. Jay, thank you, sir. Jay Pelosky at TPW Advisory. Do you care about the shutdown? Nope. Care about earnings 2 weeks away. JP Morgan, just around the corner.
A lot of people say this will be the risk event going into the fourth quarter. Do you see the proof behind all the high expectations? And if you don't, how big is the potential downdraft?
Equity futures this morning down by about 0.2% on the S&P 500. Let's get you some news worldwide. Some breaking headlines from Exxon just moments ago. With a wrap, here's the Bloomberg Brief with Ronnie Quinn. Hey, Ronnie.
Hey, John, good morning. Yep, we'll get to that Exxon news in just a moment. But first, on that shutdown, the U.S. likely headed for it. Senate Republican Majority Leader John Thune said Democrats' refusal to approve a short-term spending bill amounts to hostage-taking. Democratic Senator Chuck Schumer said Democrats could settle for some of their priorities, such as extending subsidies for Affordable Care Act premiums. President Trump and Israeli Prime Minister Benjamin Netanyahu have agreed to a 20-point plan designed to end the war in Gaza. But it's unclear if Hamas will accept the proposal, which calls for the group to disarm, relinquish control of Gaza, and release all hostages. And Exxon planning to cut about 2,000 jobs globally as part of its long-term restructuring plan. The reductions account for about 3 to 40% of its workforce. Other major oil companies, including BP and Chevron, have also recently announced cuts as crude prices fell this year. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, heading towards a government shutdown.
We have very large differences on health care and on their ability to undo whatever budget we agree to.
We're headed to a shutdown because the Democrats won't do the right thing.
That conversation up next with Terry Haines of Pangaea Policy, live from New York City this morning. Good morning. Tons of economic data this week. Might not get payrolls data on Friday. That might be delayed. There are other data points to look for. The PMIs, ISM coming up on Wednesday. Jobs data coming up later on this morning, so keep an eye on that. And we will get some earnings. Nike, after the closing bell. Nike worth a look. Just how are they dealing and confronting the tariff story of the last 6 months?
Yeah, and the supply chains. With the tariffs, there's a question of how much they can pass along to consumers. What we've heard more broadly from retailers is that they are incrementally increasing prices and taking it on the margin, also passing it on to suppliers. But in the years to come, in the months to come, expect those prices to go up.
Nike, results after the closing bell. Look out for that. 2 days of gains on the S&P running into this. We're down about 0.25% on the S&P 500. On the Nasdaq, we're down by 0.2. In the bond market, yields just a little bit lower at the front end of the curve. 2's down by 2. On a 10-year, down by 1. Let's call it 4.13. Under surveillance this morning, we're heading towards a government shutdown.
We have very large differences on health care and on their ability to undo whatever budget we agree to.
You don't say the fact that you disagree about a particular tax provision is an excuse for shutting down the people's government.
Their bill has not one iota of Democratic input. That is never how we've done this before.
We're headed into a shutdown because the Democrats won't do the right thing.
So here's the latest this morning. The Senate planning to hold a vote today in a final effort to avoid a government shutdown, with funding set to lapse at midnight. Joining us from Washington is Bloomberg's Laura Davison. Laura, welcome to the program. Senator Schumer said this, that our differences on health care, on their ability to undo whatever budget we agree to, are very large. Can you just elaborate on that? Where is there space for a compromise here?
So the space for compromise here is Democrats need about 8 of them to pass this bill. Republicans need to convince about 8 Democrats to join with them. Democrats' big ask is a renewal of these Obamacare tax subsidies. Democrats want to extend these indefinitely, permanently. Where we'll probably see the negotiations go is that they will look at, whether to extend them for just a couple years, maybe scale down the eligibility. But the point is here is that just less than 24 hours ahead of the deadline, these talks haven't even started. It's very clear that both sides are very dug in. They had this meeting at the White House yesterday. We just heard those clips of Vance and Schumer coming out of that meeting. Both sides are ready for a fight. And, absent some sort of last-minute 11th hour agreement, we are going to head into a shutdown at midnight.
Well, Laura, can they even have a last-minute agreement in the sense that House Republicans, the House isn't even in session right now? So isn't the discussion in Washington how long this could last? And what's your sense for how long we could be shut down?
It's clear that there's going to be at least a couple days here. As you mentioned, the House isn't even in town. Lawmakers would have to fly back. But this could be a much longer shutdown. We saw, a shutdown of more than a month in Trump's first term. It really is, each side is testing out whether, they are going to have the political advantage here. We're going into the shutdown because both sides, both Republicans and Democrats, think that the other party will take the blame. Of course, someone will end up, taking the political risk on here. But Democrats think that once people realize, how much healthcare premiums could go up, that they will be the victors. Republicans say that this is Democrats forcing the shutdown. They want to keep the government open, but their opponents won't let that happen.
Laura, appreciate your time. Laura Davison there of Bloomberg down in Washington, D.C. To build on this, Terry Haines of Pangaea Policy joins us now for more. Terry, this shutdown has been your base case for quite a while, and as you indicate, a lot of other people in that family catching up. Question we've got on Wall Street for markets is just how long this is going to go on for, how delayed some of these data points might be.
Well, my instinct, John, is this probably goes on for about a week. I wrote, I've been writing this for a long time, but on Sunday I wrote, basically performative politics plus policy procrastination probably prevails. And I think it does. But both parties want their, little demonstration, if you will. But I don't think either party is interested in shouldering the blame of a longer shutdown that actually becomes more dangerous to the underlying economy. Certainly Trump wouldn't want that. He just got really good economic numbers. Democrats don't want that because they don't want to be accused of undermining that. So here we are. So they both get their little moments in the sun, and then I think they move on.
Terry, when it comes to the politics, Republicans have control of the House, the Senate, and the executive branch. Was it a mistake for Senator Schumer and Minority Leader Hakeem Jeffries to actually go to the White House and have this meeting that nothing came of?
No, I don't think it's a mistake. I think you always want to look like you're engaged on either side. A Democrat's problem, and it is a Democrat problem, simply because what Republicans want is very simple. We want to keep the government open, and we're going to do a clean bill to let that happen for a little while. Democrats want stuff, so they have to figure out how to get it. Senator Schumer's problem is that now he looks like he's willing to shut the government down, not on anything substantive, but it's all very procedural and technical. Republicans have agreed, Trump agrees, to have a negotiation about the Obamacare subsidies, for example. Republicans just don't want it on a temporary spending bill. And, Schumer always says, well, they didn't want us to negotiate. They didn't do this, didn't do that. Well, Democrats weren't clear about what it is that they wanted until about 2 weeks ago. So both sides are kind of gaming this a little bit. But procedural arguments never win, and with the public. And so what's going to have to happen is, Democrats have a win in front of them that they could have taken any time in the last week, which is, say that Republicans agree to negotiate. We're going to do that. We're going to keep the government open, which helps all those unionized public workers that actually support them, and kind of move on to the next thing. But when you're trying to show everybody you want to stand up to bad orange man, that's tough lift, because you have to have that performance.
Well, yesterday when the vice president was briefing us, he talked about how rural health care funding is potentially one area of compromise. If this was to be the area for potential off-ramp, how quickly could we see that?
Well, that's why you need to me, that's why you need an extension, and why an extension of time to negotiate is part of the for my 40% case, because the details of that are simply too difficult to be worked out very, very quickly, and the prospect of harm is very great.
Terry, it did feel like something was different with the threat of widespread layoffs in a government shutdown. Why do you discount that and just think that this is more performative?
I don't discount it. I just thought the Democrats got an opportunity out of it. Well, firstly, let me say that the widespread layoffs have now morphed into furloughs for the vast majority of the government, according to your reporting and the situation on the ground. So, exactly what might happen should there be a shutdown to federal workers is fairly unclear and varies by agency. Secondly, I discount it because if there's a shutdown that ends, the implicit promise here is that the vast majority of those workers come back. That's very true if there's a furlough. So what they're trying to do is engage in kind of a technical exercise to save money, but understand that that's a pressure point. That's a pressure point on Democrats to not have a shutdown in order to help the public sector unions, just like threatening no data from the BLS, for example, is a pressure point on, among other places, markets in order to get Democrats to think twice about this.
Just quickly here, Terry, is the shutdown only going to end when the Democrats cave?
I don't think they cave. I don't look at this stuff in a binary manner generally. What they need to do is take the win that's in front of them, frankly, and they have a win. If people want to negotiate on their priorities, that's a yes, right? So you take the yes, and good things happen. But I think what my 60% base case now is that you have to have, at least from the Democrats, you have to have at least a little demonstration that you're willing to stand up to the bad orange man, which you haven't really had all year.
Terry, appreciate it. Terry Haines there of Pangaea Policy. Let's think about the calendar here. We've got payrolls on Friday. You talked about CPI. I think it's 2 weeks tomorrow. So depending on how long this goes on, that depends on the kind of data points we'll miss out on.
Yeah, and that leads us up to the Fed meeting, which is October 29th, 30th, which means that we might have no new information that is the gold standard for the Fed to work with before cutting it again 25 basis points.
Do we need Fed officials? Can we confirm that? Are they going to be kept on?
Terry Haines said that it's a threat from BLS. There's a chance potentially President Trump deems them essential, and we get the report.
Chair Powell's essential, isn't he?
I think so.
Absolutely.
If he doesn't get paid, he's
Steve
still showing
Byron's
up.
essential these days for this administration.
Couldn't agree more. From New York City, this is Bloomberg. We Two-day winning streak on the S&P 500, lower this morning, down by 0.2%. Likewise on the Nasdaq, on the month so far for September, up on the month by 3% on the S&P. On the Nasdaq 100, up by 5%. For the benchmark, the S&P 500, we're looking at a fifth consecutive month of gains. That's equities. Turn to the bond market. 2s, 10s, 30s. 2s on the month, virtually unchanged. Yields down just a basis point on the session, 360. Something that's not unchanged. Check this out. Gold, up 10% for the month of September. A monster rally for precious metals.
Yeah, it's been a haven, and it continues to be as people try to understand the resilience of the bond market. I'm actually more focused on the bond market today. The idea that Saudi Arabia, the Bank of Saudi Arabia, is single-handedly reducing borrowing costs around the world because of their increase in production, and how that is driving some of the action that we saw yesterday in the bond space. Not the Fed, it is the central bank of the Middle East.
Tick crude yesterday morning. This morning, just to finish on gold, up 10%. Month to date, the biggest monthly gain potentially since 2020. 3 hours away from the opening bell, let's get you some single names, some morning movers. With the latest, here's Yahira. Hey, Yahira.
Hi, John. We start with EchoStar. Those shares are surging 7% in the pre-market. On our reporting here at Bloomberg, that Verizon is the latest company showing interest in buying some of its wireless spectrum. Remember, AT&T and SpaceX also bought some and paid well above book value. So investors are hoping this means another big payday for EchoStar. And moving on to Coty, this is the company behind the likes of Sally Hansen and CoverGirl. Shares are rising 1.75% as investors hope that a newly announced strategic review will revive its consumer beauty business, which has been struggling, sales falling for 3 straight quarters. So they are weighing options such as partnerships or even divestitures while doubling down on fragrance, which is a hot area in the beauty market. And we end on Firefly Aerospace. Those shares are plunging nearly 10% in the pre-market after the company said that one of its rockets that was due to launch in the coming weeks was destroyed during a test yesterday. It's the latest mishap. It had another incident back in April, and it just went public back in August. So it is still trying to prove that it can compete in the ultra-competitive commercial launch market, dominated, of course, by SpaceX. John?
Yahira, thank you. More from Yahira in the next hour. On our radar this morning, the Vice President, J.D. Vance, saying a government shutdown is imminent and pinning the blames on Democrats. Yesterday's meeting at the White House failing to bridge the divide over Democratic demands for healthcare subsidies. Elsewhere, President Donald Trump unveiling a 20-point plan for a potential end to the Israel-Hamas war, calling it a historic day for peace. The proposal, backed by the Israeli Prime Minister, calling for an immediate ceasefire and the release of nearly 2,000 prisoners. And finally, the president also announcing new tariffs on imported wood products, including a 10% tax on lumber and up to 25% on kitchen cabinets. The move, which starts October 14th, is designed to boost domestic manufacturing.
So once again, we see the president going into just looking at sectors and using 232 as an avenue, a path forward to enact these tariffs. All of this is happening while we are waiting for the court to decide whether or not IEEPA was legal or not. If the courts come down and say it was illegal to use IEEPA, well, look, this administration is going to be able to raise funds via another avenue. And potentially we're going to see more of this if IEEPA is struck down.
Nathan Sheets of Citi says this story is about to bite. Manny Roman of PIMCOM on the programme yesterday said something similar, that this could be a thing for the equity market into year end.
Especially if we start seeing the actual cost to margins from some of these tariffs. Who are these tariffs for? Especially if they are supposed to protect industries. And with the home builders, it's even more interesting because there has been a groundswell to support home buying and home building in this country. And all of a sudden you have the National Association of Home Builders saying our housing crisis is a bigger threat to national security than imported lumber or timber. It disproportionately hits Canada. A real question here about how much companies are going to have to adapt and adjust as they start seeing the real world impact.
Remember the earnings call when the RH CEO was throwing around F-bombs? He also said, God forbid they throw another tariff our way. He said, give me a call. I run the biggest luxury brand in the world. Give me a call. Well, good morning. Here's another tariff.
Yeah, the RH CEO not in a good place, that's for sure. Nike's going to be in focus with the tariff story absolutely dominant. Earnings are due after the market close, with investors eager to see the impacts of tariffs on the company's turnaround progress. Jay Soul of UBS raising its price target on the stock to 71, but writing, we don't expect Nike to provide formal full-year 26 guidance, and tariff policies remain uncertain. Jay joins us now for more. Jay, welcome to the programme, sir. Thanks for making some time for us. Let's just talk about your channel checks first. How do you think demand has held up?
Well, I think demand is getting a little bit better for Nike, but it's still weak. On a year-over-year basis, sales are probably down year-over-year for Nike this quarter.
What's preventing them from guiding into 26 with a little bit more clarity?
Well, I think you touched on it before. I think tariffs is one factor that's really limiting their ability to have to give guidance, because obviously there's the cost impact, but also they don't know what impact the price increases will have on consumer spending as we get into the all-important holiday season. Because they don't know how to forecast that, they're going to be hesitant to give guidance, we think.
That said, Jay, a lot of people said that the back-to-school season is a good predictor of holiday demand. Do you think that that correlation is broken down this year?
Well, I don't think it's broken down. I just think we're going to have a different environment in holiday than we've had in back to school. Back to school was good. By all accounts, people were out shopping. There was good fashion trends. A lot of companies reported upside to consensus estimates when they gave their earnings updates. But in holiday, maybe we see prices go up a little bit more because of tariffs, and that could create a different dynamic, which causes the consumer to pull back. Now, there's a chance that might not happen. If you ask consumers right now, we do a survey of 8,000 U.S. consumers every month. They're saying they're feeling pretty good and they want to have a great holiday season. But, maybe that attitude will change once they see price increases at retail.
What's interesting to me is a lot of CEOs of retailers don't know themselves how much consumers are going to be able to absorb these price increases. They're kind of testing the water. It seems like some brands that have more staying power, more popularity, more flash, are able to raise prices more than others. How is Nike doing in that competitive landscape?
Well, I would say Nike's sort of in the middle of the pack. I think the key in the world of athletic apparel and footwear to raising prices is innovation. When you have new innovation that consumers are really excited about, the brand that offers that innovation can raise price and the consumers will happy to pay it. But right now, Nike doesn't have that much new innovation. They have some, but they need more. If they had more, they could raise prices better. But right now, like I said, they're sort of in the middle where they need more to really get the price increases they need.
What about when it comes to just being cool? My 9-year-old nephew called me because he wanted on shoes, sneakers, for back to school after his mom bought him Nikes. Is Nike's just still struggling to be relevant?
Well, first of all, that's a great story. Your 9-year-old wants on. I think that's a pretty great anecdote there. I think the issue for Nike is that for the last few years, they were really depending on 3 or 4 key styles. The Air Jordan 1, the Air Force 1, the Air Max. And consumers really bought so much of these styles. Now they're sort of looking for something different, and Nike doesn't quite have enough to offer them yet in that important lifestyle category for kids who just want to go to school in a cool looking shoe. So, and that's kind of related to what I mentioned before. So they don't quite have enough innovation. When they fix that issue, Nike's going to be strong again.
They just did a mashup with Skims, and of course the World Cup is next year. Are these avenues where they could potentially get some of their mojo back?
Perhaps, the World Cup is a great event. Obviously, it's a great global sporting event. Nike obviously is one of the biggest, if not the biggest soccer brand in the world. So that should be a good opportunity for Nike to show what it can do, both in terms of product innovation and marketing. The Nike Skims thing, we'll see. It's new. Obviously Nike has had big ambitions over many years to do better in women's apparel. This is the latest attempt. We'll see if it works.
Jay, the losers, the real losers are elsewhere. The second biggest loser on the S&P this year, Lulu. The third biggest loser on the S&P 500 this year, Deckers, think Hoka. Jay, what's happened with those two companies? What's going wrong?
Well, I think what's going right, first of all, there's still a great trend toward athletic footwear. Consumers are buying a lot more athletic footwear this year than they did last year. But with those stocks in particular, the market had super high expectations at the beginning of the year, and neither company really lived up to those expectations. And that caused huge PE multiple contraction. The industry is still very healthy in our view. It's like sometimes, there's stocks that outperform others based on, the companies just do better. And for Lulu and Deckers, the situation is, like I said, both companies just didn't quite live up to what the investors were hoping for.
How much, Jay, do you expect announcements of layoffs going forward in the next 6 to 12 months? We've already seen it on the margins at a number of retailers with a greater adoption of different technologies. I'm thinking AI, algorithmic machine learning.
Well, I think AI is certainly helping a lot of companies in the world of apparel and footwear. I don't really expect a lot of layoffs. I expect productivity gains to be used to offset maybe margin pressure in other areas from tariffs. I think that AI is going to open up some employees within companies to do more high value add tasks. Making apparel and footwear is a very creative process that requires, smart people. And it's better if they can use their time thinking creatively than doing maybe easy tasks that can be passed off to AI. So I think the employment outlook for apparel and footwear is actually still pretty good.
Hey, Jay, appreciate your time. Jay Solder of UBS. Jay, thank you, sir. Lulu, down 53% year to date. Deckers is down about 49. Those stocks cut in half. Best performing stock on the S&P 500 this year, guess what? Robin Hood.
That's
the number one performing name on the S&P for 25.
How many clothes do you have to actually buy if you're sitting in your basement trading stocks?
Up 267%.
Bitcoin, gold.
It's not bad, is it?
Bitcoin.
Does that speak to the year so far?
It basically does. The average person isn't going out and bulking up on beautiful or even mid-tier clothes.
Well, the other thing, too, is the styles are changing. So this is not as cool anymore for a lot of these brands. They're just not innovating in a way and connecting with the younger generation.
Nike reporting after the closing bell. Look out for those numbers a little bit later. Equity futures on the S&P just a bit softer. We're down by 0.2%. With an update on stories worldwide, let's get to your Bloomberg brief and cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Trump and Defense Secretary Pete Hegseth will address U.S. military officials in person at a Marine base in Quantico, Virginia today. Last week, Hegseth summoned top military commanders to the base for the meeting. A Pentagon spokesman did not provide a reason for the meeting, nor say what Hegseth plans to tell the high-ranking officials. BHP shares are dropping this morning on the deepening dispute between China and the world's biggest miner. Sources telling us here at Bloomberg the nation's state-run iron ore buyer has told major steelmakers to temporarily hold all new purchases from BHP. Boeing has started working on a next-generation single-aisle aircraft that could eventually replace the 737 MAX. The Wall Street Journal reporting the new narrow-body aircraft is in early-stage development. It comes amid growing concern about the safety of the current 737 MAX. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next on the programme, adding to tariff risk.
Life in industrial America isn't great. I mean, top line is not growing, and one of the question that we don't know is the impact of tariff. There's a whole leg of the equation that we haven't really seen.
Up next, we'll catch up with the former White House senior trade advisor Kellyanne Shaw, live from New York City this morning. Good morning to all. You're watching Bloomberg TV. Two-day winning streak on the S&P 500 as we look to close out the month of September with another monthly gain. We're looking for 5 consecutive months of gains on the S&P 500. Futures this morning down by 0.2. On the Nasdaq, down by 0.16. One single name to look at, Exxon. News this hour that Exxon plans to cut about 2,000 jobs globally. That stock is pretty much unchanged this morning, but that effort from Darren Woods that goes back to something like 2019 to restructure this company continues.
Yeah, and this has to do with a Canadian outpost that's cutting a significant amount of jobs. It comes after a number of job cut announcements from big oil companies. ConocoPhillips cutting 20 to 25% of their staff. Chevron idling 15 to 20% of the staff. BP, 15% of the staff. Halliburton, up to 40% in some of its units. You look at this, you think, okay, lower oil prices. What is that doing to the labor backdrop for the oil sector? That's an interesting story.
The Dallas Fed puts out a quarterly energy survey, and this was the last one for the current quarter. 3 big issues here for exploration and production firms. Excess in the global oil market is restraining oil prices near term. There is continued uncertainty from OPEC Plus unwinding production cuts. And finally, trade and tariff changes and the resulting geopolitical tensions. Costs are up. This is a problem for the oil patch right now. They're struggling.
They're facing costs. They're facing new technologies that can allow them to perhaps trim around the edges. And then they're also facing just lower energy prices with the Central Bank of Saudi Arabia continuing to gun it in order to lower oil prices. It's a pretty toxic brew for them. It just raises a question of what this does longer term to their productive capacity, given how the U.S. became almost oil independent, energy independent when it came to the oil patch in years past.
The latest from Exxon this morning, planning to cut about 2,000 jobs globally. Under surveillance this morning, adding to tariff risk.
Life in industrial America isn't great. I mean, top line is not growing, and one of the questions that we don't know is the impact of tariff and what will happen in corporate America in terms of how they're going to deal with either passing on prices or diminishing margin. And so there's a whole leg of the equation that we haven't really seen.
So here's the latest this morning. President Donald Trump ordering a fresh round of tariffs on lumber, cabinets and furniture set to take effect in the middle of October. John gets now to discuss as the former White House senior trade advisor Kellyanne Shaw. Kellyanne, good to see you. You are charged with explaining where this ends. Where does this end? What are the limits of this strategy, this policy?
Well, I don't think there is an end in sight, at least not for the duration of this administration. I mean, the president is continuing to roll out various tariffs. We obviously saw timber and lumber last night. We're expecting pharmaceutical and trucks this week. And there's at least 11 more 232 investigations in queue, if not more, that we don't quite know about.
The problem is you put tariffs on one sector, you might help them out, you'll hurt another. Lisa was talking about house building. We need to build houses in this country. You put tariffs on lumber, great for domestic lumber. Not so good if you're trying to build a house. See this across the board when it comes to things like furniture. Put tariffs on furniture. Fantastic if you're a furniture maker in North Carolina. Good news maybe. But if you're restoration hardware, to Anne-Marie's point, you've got a problem. What's the overall strategy here? Are they thinking about who this hurts, who this doesn't hurt, if it helps people upstream, who it hurts downstream? Are they going through all of that?
Yeah, I think it's a great question, and we are seeing some of this tariff inversion issue where all of a sudden the parts and components that you need to manufacture become disproportionately more expensive. So it's less competitive to build or create in the U.S. So what the administration is likely going to do over time is try to uninvert these tariffs. But right now their strategy is to get it all out. This is a once-in-a-generation change in terms of the way the U.S. collects tariff revenue. And I think we'll see some changes over time to try to make some tweaks along the margins. But right now, you're right. There's just a lot happening right now.
Is this more about the revenue right now than it is about really shifting where manufacturing happens?
I have always been of the view that the revenue is not the most important part of the president's strategy. I think that this is about rebalancing the trading relationships. It's about the trade deficit, and it's about national security and supply chains. I think the revenue is a happy circumstance from the administration's perspective. I also think it's really important to the markets in a way that for some in the administration, it doesn't quite register.
If I were an investor trying to understand what national security means, and I think about lumber as a national security issue, but TikTok, at least if it's owned partly by Oracle, not being a national security issue, and some of the chip exports maybe not anymore being a national security issue, is there any cohesive thread as to what is and what isn't a national security risk?
So I think it's a great question. And part of it depends on the sector or the good or the service that's being targeted. So when you look at these sectoral tariffs, the concept behind it is there are certain things that we need to produce in the United States in the event of wartime event, pandemic, some sort of force majeure. We need to be able to have production capacity. And so those are on the goods themselves. These other export controls and other types of investment screening mechanisms, those are about services and other types of economic behavior. So I do think you can separate those a bit.
If IEEPA is struck down in the courts, is that why you think they're doing all these sectoral tariffs? Because you said maybe a dozen more are set to come.
Yeah, and there could be more that we don't even know about because they aren't announcing when they launch these investigations. What I would say is I don't think that replacing the current IEEPA tariffs with 232 strategy is very good policy, in part because the IEEPA tariffs are about countrywide tariffs. These sectoral tariffs are really about products and specific products. They don't quite match up. Now, that's not to say that the administration isn't going to use all the different authority they have to try to replace IEEPA, but I do think that creates a bit of a messy patchwork if that's in fact what's going on.
We also had the Commerce Department expand the entity list yesterday. What does that mean for the U.S.-China ongoing trade negotiations?
Yeah, I think that's a great question, too. And those negotiations were continuing just this last week when you had Chinese negotiators in town. So we had understood that this move was previewed by the U.S. to the Chinese side in advance, which often happens with some big moves on either side. So you try to take the temperature down and you don't have this immediate reaction. But I think what it shows is that the U.S. and China are going to continue to walk and chew gum at the same time, meaning they're going to continue to take measures that hurt one another at the same time as try to make progress where they can.
Are they going to buy some soybeans?
It sure looks like...
It's becoming a massive problem.
Yeah, it sure looks like they're gearing up for that. You had Chinese officials visiting the Midwest, talking to business leaders, potentially flagging some interest for farmers. I think that's going to be a top ask by the Trump administration. But you've also had, on the other hand, the president say that he's going to give some of this tariff revenue to farmers to try to make up for some of the difference. So you've got two things going on.
The government needs to be open in order for them to vote on giving this bailout to the farmers. But why is the purchasing agreements not in the forefront? Why have they not been brought up on the number of trade negotiations Besant, Rudnick, Jamieson Greer have all had with the Chinese?
Well, I strongly suspect they have been discussed, in part because the Chinese already committed to purchase soybeans, aircraft, and energy products as part of that phase one deal from way back in Trump 1.0, and they didn't live up to those commitments. But for China to make some of these big purchase announcements, that to me signals something that will happen alongside a leaders summit. So we could see that as soon as the APEC meeting, but most likely some sort of Beijing trip when President Trump goes to meet formally with President Xi.
When do we have this APEC meeting potentially between Xi and Trump? I mean, they said at minimum there's going to be a pull-aside as they attend this summit. Who has the leverage going into this?
I think both sides have leverage. I mean, clearly the Chinese have leverage over the United States when it comes to rare earth magnets, critical minerals. They've got choke points on certain aspects of the U.S. economy, which is what is so concerning to the administration. But you heard Secretary Bazinet last week talk about chemicals, the fact that China can't fly their airplanes without the United States. There are choke points both ways, and I think both countries are trying to navigate that dynamic.
It was always clear that the U.S. and China were something of adversaries. Do we have a clearer sense of who the U.S.'s friends are right now?
Well, I think this administration is a bit more transactional than we've seen previous administrations, meaning we can be friends, we can be allies, but we can also go after you for economic reasons and on the trade front. And the opposite can be true as well. We can cooperate on trade and be national security adversaries, which is some of the dynamic we've seen play out with India and purchases of Russian oil. But I would say our traditional allies continue to be our allies, but there is friction on the trade and economic front.
Are the Europeans picking a side?
This is something the Europeans have always struggled with.
Big time.
Yeah.
And something we need to sort out too, because you look across the EU right now and you ask Spain, I think they've got one view. Ask Italy, they've got another.
This is the feature and the bug of the European Union, is that they don't speak with one voice, and that continues to be an issue. I just wonder, can you distill the idea of an economic relationship from a geopolitical and strategic one? Is there really a dividing line between these ideas, or are these typically intertwined, that economic and strategic tend to go hand in hand?
Well, China's been an adversary for a long, long time, and we've still traded with them. I think it's the first time really that we've had tariffs that are so high that trade has started to break down.
And you were the one that pointed out that the initial thought was the more that we do business, the more you actually increase some of the ties and increase the global system. Right. Well, at what point, if that's not true, does that break down? But that doesn't undermine the idea that typically, I mean, the idea of money, sorry, I'm going to get a little philosophical, but the idea of money is actually rooted in debt. It is the social ties that bind one another. It isn't necessarily, I owe you this for the number of apples, so I'll give you 2 shoes. It's the idea of, I owe you this in the sort of social relationship. So at what point are those connected?
Yeah, Russia, kind of the example of the moment to show that doesn't work.
That's true. Exactly.
Russia and the Europeans. That's what Angela Merkel thought. We'll trade with the Russians, we'll keep them on side, and look how that worked out.
It hasn't worked, so what's the new order? This is a new moment.
Coming together in real time.
Yeah, exactly.
Kellyanne, it's good to see you. Thank you. Thanks for being here. Kellyanne Shaw there, the former White House trade advisor on the push forward between the United States and China and a whole lot more. The tariffs keep accumulating. If you are just joining us, welcome to the programme. Equity futures just a bit softer here on the S&P 500 on the final trading day for the month of September and for Q3. Coming up next, Phil Orlando of Federated Global Investment. We'll catch up with Monica Guerra of Morgan Stanley, Venu Krishna of Barclays with a new report on AI and lots of questions about bubbles. And later, the Citizens Financial CEO, Bruce Van Saun from New York City, the second hour of Bloomberg Surveillance, up next.
The market continues to make new highs.
Higher productivity supports higher valuations.
The market clearly is pricing in a decent amount of expectation for forward growth.
Let's not just focus on the expectations, but also about the market action.
You need to put your money somewhere. And the reality is the US is the only place where you can actually put scale.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores will look like this. Equity futures on the S&P 500 a little bit softer, following 2 days of gains and heading towards a 5th consecutive monthly advance on the S&P 500. In the bond market, 2-year and 10-year looks like this. Yields unchanged on 2s on the session and on the month so far for September, 361 65 as we count you down to a week full of economic data with a major question mark over payrolls as this government heads towards a shutdown.
It seems like it's looking less likely that we'll get that. Interesting. Markets are shrugging it off, saying we care about ADP more and it's been more accurate anyway. At the same time, it raises a specter of not getting CPI next week and having no new official information, the gold standard type of data coming before the Fed has to make another decision. This goes to the stasis you're seeing in two-year yields. That balance between hawks and doves kind of staying in the same place since the last time they met.
The Fed meeting is October 28th and 29th. CPI is October 15th. The question in Washington is not if there's going to be a government shutdown. There will be a government shutdown. It's for how long it's going to last. And how are you going to be a data-dependent Fed if you do not have the data? Which is why I think, even though the BLS came out with their contingency planning, I could see a scenario the president says, actually, this is really important, and I'm going to deem a certain amount of workers at BLS essential to make sure that these economic reports come out. That's not thinking right now because we have the statement from BLS, but it's a possibility.
This Fed can't agree on the data they've already got. I'm not sure what difference additional data makes at this point for some of these officials.
If I were a conspiracy theorist, I would say maybe it's actually in the best interest of policy and of the president to keep these people furloughed for a while. Because ultimately, if nothing changes, insurance is to still cut rates. And if you're going to cut rates into a reacceleration, which is what a lot of people think, then, well, you don't want any data that might actually be an upside surprise. I'm very curious to see about ADP. And if it surprises to the upside, what kind of signal this market
We're
gets.
hiding positive data now. Is that the conspiracy theory?
I'm just making stuff up. I don't think that we're actually hiding anything, just to be very clear. I'm just saying that I think that right now it is likely that we're not going to get the data, and ADP is going to be more important. That's all I'm going to say.
The Fed meeting at the end of October. Equity futures right now in the S&P negative by 0.2%. Coming up this hour, Phil Orlando of Federated Global Investment as Wall Street looks to close out the month on a high. Monica Guerra of Morgan Stanley with the clock ticking towards a government shutdown. And Bruce Van Saun of Citizens Financial Group with the US economy at a crossroads. We begin this hour with stocks inching lower ahead of fresh jobs data through the week. Phil Orlando of Federated Global Investment sees momentum building. He writes the following: given the potential for a strengthening labour market and moderating inflation, economic growth could accelerate in the second half of this year. Phil joins us now for more. Phil, good morning.
Good morning. Thanks for having me back.
Thanks for being here. Just to build on that quote, is that the story we're priced for?
Stock market's up 38% since the Liberation Day lows back in the middle of April. So clearly they're not jumping out of the upper floors of the towers because they're concerned that the labor market's collapsing. Has the data been soft the last 4 months? No question. But in our view, the data was sort of troughing here and has the potential to accelerate going into the next couple of months.
Relative to what? This is what I want to understand. Clearly, we're priced for a lot of this going into 26. Expectations have already picked up. We've had the equity market rally. How much of that has been about earnings? How much of that is just a better economic story already?
So the earnings situation we think is excellent. You look at the first quarter and the second quarter revenues up 6%, earnings up 12%, much better than expected. The consensus expectations for the third quarter starting to come in. Those numbers look pretty strong. We're in the process of upgrading our earnings estimates for full year this year, full year next year. So the earnings picture is in pretty good shape. Clearly, the labor market has been the weak link. Now, you look at the August jobs report, it was terrible, admittedly. But there are a couple of things associated with that. Number one, August tends to be the quirkiest month of the year. You've got, schools starting and starting up again, factories taking downtime to retool, temporarily furloughing workers. So the August non-farm payroll report historically is the quirkiest report of the year. So you look at, for example, Kevin Hassett, the national chairman director, came out and said that they're expecting 70,000 jobs to be revised up over the course of the next couple of months. That's consistent with what we've seen historically. All of the noise and the nonsense in August tends to get revised up. All right, that's point number one. Point number two, when we saw the initial weekly jobless claims the first week of September, the numbers were terrible. I think it was about 264,000. The market was freaking out a little bit, but we suggested take a deep breath. Number one, it's a holiday shortened week. And number two, you had the allegations of claims fraud in Texas. So as we went to the next week, which was the survey week for September, the number came down to about 230,000. Then last week came down further to about 217,000. So we think the claims are pointing to the fact that the numbers are going to be pretty good. And then, we were talking about non-farm versus ADP going into this. The expectations for ADP, about 50,000 plus. That's kind of the number we're looking for non-farm. That would be a number roughly double what we saw in the month of August for non-farm. So we think the labor market, there may be a little too much pessimism built in. So our expectation that the numbers probably troughed here and we'll start to see some improvement.
Given that backdrop, there's a mystery, and we were unpacking that ahead of the Nike earnings after the bell. This idea, even CEOs don't know how much consumers will absorb price increases. What is the connection right now between corporate profits and potential inflationary pressure?
No question. If you look at the piece that I wrote last week, focused on how good the back-to-school season was. Back-to-school was up 4.2% 3 months through August. Back to school a year ago was only up 2.3%. So the consumer's in pretty good shape, particularly at the high end. But I think there is absolutely some consternation about what pricing is, particularly at the low end of the price spectrum. So companies are going to have to, sort of weigh that situation. High-end consumers can afford a little bit more in pricing, but the question of are there going to be any forced pricing issues because of the tariff situation that companies need to pass on in order to maintain profit margins? Profit margins have been pretty strong up until now. Is that situation going to deteriorate in the third quarter and the fourth quarter? We don't know the data yet, but that's something that we're going to have to see.
The big question mark over this has been holding back the broadening out in the S&P 500, in the Russell 2000, in the S&P 600 pick your index. How much are you betting that we are going to see that broadening out versus just this consolidation in big tech, this idea that the profits will continue to be driven by the biggest 10 names?
We're absolutely in the broadening out camp, and that's been our call for the last year. And case in point, look how well the small caps have done, both growth and value, over the course of the last couple of months. In our view, the small caps were completely mispriced. And once we began to see the Fed tipped over their cards, they're going to cut interest rates. An interest rate reduction cycle is hugely beneficial to the small cap companies. It improves their ability to self-finance, kicks off an M&A and an IPO cycle. And you've got a situation where domestically we think economic growth is accelerating. Small cap companies do 80% of their business here. If the U.S. economy is doing well, that's going to benefit small cap companies.
But aren't more tariffs going to hurt small cap companies? Even if they do business here, a lot of the imports could be coming from other countries.
Well, again, that's a case-by-case situation. I was on Bloomberg Radio recently, and we were talking about this, and I got some random person that sent me an email when I got back to the office asking that question. Isn't that going to impact pricing and imports, and won't Christmas sales be a disaster? And the answer in our situation is we think it's going to be a case-by-case situation. How is a company sourcing what they're selling? What's the pricing of that? Can they source more domestically? What's their labor situation, immigrant versus native born? There are a lot of factors here that are going to dictate the answer to that question.
Is there an area within the small caps that's immune to a lot of this?
We love healthcare, and within healthcare, biotechnology. Our biotechnology gurus are telling us that the pipelines have never looked better, yet the valuations have never been more extreme out of favor. And what we've been waiting for is some catalyst, and we think the interest rate cutting cycle is that catalyst. The big cap companies, Pfizer, Merck, et cetera, will start to think about M&A activity. Lower interest rates, again, will make it easier to self-finance. And people are now going to focus on the really good phase 1, phase 2, phase 3 clinical work that these companies have done with their drug development. That's a sector we think is poised to move higher.
Phil, it's good to see you.
Thank you so much for having me.
Thanks for dropping by. Phil Orlando there at Federated Global Investments. Small cap futures on the Russell 2000 a little bit lower this morning. On the S&P 500 down by close to 0.2%. With an update on stories worldwide, here's your Bloomberg brief with Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Federal agencies preparing for government shutdown with detailed plans that call for temporary furloughs but not permanent mass firings. At least 8 cabinet departments comprising more than 2/3 of the federal workforce had detailed their shutdown plans as of Monday afternoon. Together, they called for more than 400,000 employees to be sent home as non-essential. President Trump ordered 10% tariffs on imports of softwood timber and lumber, also a 25% duty on kitchen cabinets, vanities and upholstered furniture. The tariffs are set to apply from October 14th, with some increases targeted to take effect next year. Trump said the planned actions aim to shore up domestic manufacturing. After a decade, McDonald's is bringing back the fan favorite Monopoly game in an effort to boost sales. The promotion returns October 6th for a limited time, but with a digital twist. Instead of a physical board, customers will play through the company's mobile app. Prizes apparently range from free fries to a $1 million cash prize. And that is your Bloomberg Brief. John.
Bonnie, thank you. Appreciate the update. Up next on the programme, a shutdown, showdown.
We have very large differences on health care and on their ability to undo whatever budget we agree to.
We're headed to a shutdown because the Democrats won't do the right thing.
A conversation up next with Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning. Equity futures on the S&P just a little bit softer as we close out the month of September. We're down by close to 0.2%, softer by just 0.1% on the Nasdaq 100. Under surveillance this morning, a shutdown, showdown.
We have very large differences on health care and on their ability to undo whatever budget we agree to.
You don't say the fact that you disagree about a particular tax provision is an excuse for shutting down the people's government.
Their bill has not one iota of Democratic input. That is never how we've done this before.
We're headed to a shutdown because the Democrats won't do the right thing.
So here's the latest this morning. The US closing in on a government shutdown with funding set to lapse at midnight. To discuss, joining us now is Bloomberg's Laura Davison. Laura, welcome back. Walk us through how this cascades through the government over the coming days. What happens just after midnight tonight?
Yeah, so even starting today around midday is all the federal agencies start all of their shutdown procedures. So they each have plans that designate certain employees, about 60% or so, as essential. They will stay on the job, they will not be getting paid. And then about 4 in 10 employees will be sent home and will cease all their work for the duration of the shutdown. There is a law that says all of these folks who are furloughed will get back pay. But this, if the shutdown lasts for several weeks, it could be, several weeks before they get that pay. We saw, back in 2018 when there was a 34-day shutdown that started to cause some economic ripples as people went 2 paycheck cycles without getting paid. In addition, the White House has also threatened that certain non-essential employees could be fired. We have not yet gotten any indication from agencies about who might be in scope there, but that is another pressure point that the White House is putting on Democrats to end a shutdown.
Laura, appreciate the update. Laura Davison down in Washington, D.C. MH, how are you thinking about this? What does this actually mean for Wall Street?
For Wall Street, the only thing they're really going to care about is the economic data. BLS has put out what they think is going to happen if we have a shutdown, which is we're going to cease to have any economic data. I still think there's a chance that the president would deem some members of BLS essential and then basically say at least minimum release the jobs report on Friday, because all the work for the jobs report would have been done, maybe potentially won't get CPI on October 15th. Besides that, this is just pure politics until they reopen. And then there's going to be a lot of discussions about things like a bailout for farmers and, appropriation bills that need to get done to actually fund the government.
I think about Libby Cantrell and her notes. But the one but that I would say to that is the market will care if you start to see some pretty widespread layoffs and if you start to see an appropriation of power in order to cut some of the federal workforce. Do you start to see some more ramifications priced in?
I do like the second paragraph of a Libby note.
I love that.
If you're not familiar, there's always a but.
Yeah.
And then a paragraph.
But I can hear her voice like, there's this and this could be but. And I think about pretty much every topic through that lens now.
Let's get to some of that now with Monica Guerra of Morgan Stanley. Monica, welcome to the programme. A lot of people looking through this. Wall Street saying it doesn't matter, just show me the economic data and everything's okay. Do you think about it slightly differently?
I think you have to look at it, from where the risk actually could bubble up. Now, historically, markets do look through. You get markets outperforming at average about 4.4% during periods of shutdown. Granted, they can last from 3 days to 34 days, so that's a huge window in time. But typically, even with the long shutdowns, you still have markets outperforming. So the risk comes and which industries and sectors are most reliant on those government contracts, and that's defense, healthcare, et cetera. Is this a nice buy opportunity? Potentially, if you're trying to, take a tactical approach. But again, it's typically a short window where markets like to look through.
Well, that last shutdown, that was 34, 35 days in the end. What kind of impact did that have on Wall Street and the economy?
Very little, because the macroeconomic factors, were really important. The other thing that's critical here is that it was a partial shutdown. It wasn't a full shutdown. So in 2013, we had a full shutdown, and I think the estimate from the CBO is that they lost about 24 billion or so in productivity. In 2018, even though it was a double the length, twice as long or more of a shutdown, they only lost 11 billion, 3 billion net at the end of the day after everyone was made whole. So even with that length of time, there could be, a variety, of factors that could impact growth.
The conversation I'm hearing out of Washington yesterday, today, this morning, talking to people is obviously the government is shutting down. It's the length. What are you thinking about in terms of how long the government will be shut down?
So when we're thinking about the political factors here, with the Democrats, they are taking a stand. Earlier this year, when Schumer came to the table and they passed the CR, there was a large outcry within the Democratic electorate, upset that they moved so quickly. So I think it does behoove them from a voter standpoint, of speaking to their base, to actually hold a firm line. But then they have to balance that with pressures that could potentially come from the White House. They were calling for mass layoffs. That's likely not to happen. But other areas that could be a catalyst is potentially, apportionment control, meaning that the president could deny a transfer of funds post or during, this shutdown as essentially a catalyst opportunity to look under the hood and see where they can cut.
Why has that been the shift in focus away from possibly some sort of mass layoff program and more just shifting where money goes in the government?
So if we look at what happened with DOGE, they were largely unsuccessful, They were able to get some cuts through. There was such significant power within the federal unions, protecting status of workers, and the legal response, was essentially a significant pushback. They don't want to run into that sort of hurdle again. So I think it's more of an issue of which agencies, which programs, which departments are ideologically aligned with the president, and could those areas actually be in trouble if they choose to withhold funds?
Okay, so let's talk specifics. What are the areas that could possibly see reductions in funding? What are the areas that could potentially see increases in funding as soon as the next few weeks if there is some sort of shutdown?
You could see some risk. This is pretty high level and widespread. It's already happening on the DEI front. That's likely to continue. They could also look at anything that's clean energy related. You could maybe see some impacts to EPA. And then the other areas that I think are critical is on the Medicaid healthcare front. They're continuing to want to clamp down, especially on those ACA subsidies that the Democrats are looking forward to extending. Do they get that? That's the big question.
What's the off-ramp?
The off-ramp here, I think, is if you start getting really notable aggressive activity from the White House, and then that could move the Democrats forward, because there's significant amount of programs that they don't want to lose, and they want to make sure that their support outside of ACA subsidies. Right now, this is their bargaining chip. This is the thing that they want to get a win on. If they can't get that, and everything else starts to see this, you start to see the train go off the tracks in other ways, that could be the catalyst that gets the Democrats to the table.
The vice president yesterday was talking about rural health care policy and how potentially that is one place where they can come to an agreement. Is this where the off-ramp will be, though? It will be in the healthcare policy sector.
If Democrats get a concession, that's their off-ramp. The other piece that I'm talking about is the stick off-ramp, That if the White House says, no, we're not negotiating with you, we're not giving you those subsidies, then you have to come to the table because we're going to cut other things, And it's more of a fear tactic. Now, on the ACA and rural healthcare component, when you're looking at red states, rural red states, they're most reliant on ACA. They didn't do Medicaid expansion. So the Medicaid rollbacks don't really impact them. So it is really all about ACA subsidy extension. And that is an area where you do get bipartisan consensus.
Taking a step back and looking at some of the macro implications, not clear what the longer term macro implications are for bond yields based on just sort of this broader sense that it is essentially an economic issue. You do see, though, longer term, an impact on the dollar. There has been a weaker dollar associated with shutdowns. Do you expect that to be correlation that continues this time around?
Yes, this is a historical, relationship. One of the things that we want to note, though, is that the length of time, right, is going to impact that how weak it goes, right? So if we get a week, that's going to be very different than if we get another 35-day window.
Monica, good to see you. Thanks for being here. Monica Guerra there of Morgan Stanley. No idea how long this lasts. Pleased you brought up gold. It's having a massive month. I think that's taken the temperature of government dysfunction, not just in America, but worldwide, across Europe and elsewhere.
Yeah, for those who say, well, the euro is going to gain against the dollar, then there's France. And people say, well, just kidding. At the same time, you're right. Gold is the barometer of international developed market dysfunction. And that is the only place that people have found as a reliable haven. It is fascinating to see the correlation as long as this goes on, how much more gold surges.
There's risks in the Middle East, gold goes up. There's concerns about if France's government's collapsing, gold goes up. Fear about government shutdown in the United States, gold goes up. Gold is going up even if the S&P 500 is going up. It has basically become this absolute risk-free bet that everyone wants in their portfolio.
The Russia piece of this is absolutely critical. The Europeans are still flirting with the idea of taking frozen Russian assets. Then that's a massive piece of the gold move we've seen over the past few years.
This is driven by central banks. We should put that into perspective. And the amount of buying from central banks, particularly from places like Russia, like China, that want to diversify away from the dollar, has been a big driver of it. But everybody's getting on the train. Everyone who comes on, they say, well, privately, I'm doing it for myself. I've got gold bars in my closet. But for clients, I can't really recommend that as a massive hedge. But you hear that more and more. I don't have any gold bars in my closet. So if you're looking to come to my apartment,
neither do I, for the record.
Don't even look, because it's not going to help you.
It was a seismic move for the Biden administration to freeze those frozen assets. And the Russian central bank was thinking, well, we can't buy dollars anymore. Can we buy euros? What can we actually buy that we think is going to be safe? And not just the Russians did it. You see the Chinese doing it. You see other governments do that because they think it's the only real safe place to go when the U.S. government basically is showing that they can just freeze all of your assets on the drop of a dime.
Have we had the tour of Fort Knox yet? Do we know the
yet.
gold's there?
I asked about that.
What's going on with that?
I think it was just a conspiracy theory.
Cue the conspiracy
But I would
theories.
love to get a tour of Fort Knox. But the Treasury Secretary said on this program or on this table that if any senator wants a tour, so maybe I need to write my senator and say, can I come along for a tour of Fort Knox with you?
Want to know if the gold's there or not.
Well, I know that the value is supposedly surging to record highs. So there you go. I mean, that wasn't there a story yesterday about that?
$1 trillion now,
yeah. Exactly. So we've got $1 trillion. Maybe monetize that, pay back the debt.
Well, what this government could do is market gold to its actual value, change it. That would be, as you say, trillions of dollars to add on their balance sheet.
Gold right now pulling back from all-time highs. We're down about 0.6%, up on the month by something like double digits. Coming up on the program, Venu Krishna of Barclays saying the AI bubble concerns are overblown. Plus, Yahara has your morning movers. Wolf speed soaring as the firm is set to emerge from Chapter 11 bankruptcy. That stock is up by 16%. Heading towards a fifth month of gains on the S&P 500, the longest monthly winning streak since last September. As we close out the month of September, equity futures down by 0.2% on the S&P, on the Nasdaq down by 0.1, on the Russell down by 0.3. In the bond market, 2-year, 10-year, 30-year, 2-year, totally unchanged on the morning. On the month as well, this debate at the Federal Reserve is becoming clearer. If you thought this was a one-way trip to another rate cut, 2, 3, 4, 5 of them, the debate of the week, the Fed speak we've seen, I don't think indicates that at all.
The problem is that the debate on the Fed is ideological. It has nothing to do with actually the data unless the data comes in decisively in one direction or another. Right now, there is a bias to cut unless there is evidence of inflation to the other side. You are seeing that inflation if you look at it in certain places. So the question is, which data do you prioritize? And that continues to be the question.
We'd just like some data this week. Maybe payrolls Friday. Let's see if we get there as we count you down to the opening bell about 2 hours away at 7:30 Eastern Time. With your morning movers, here's Yahara. Hey, Yahara.
Hi, John. We start with Wolfspeed, a company that has been in the doldrums after piling up billions of dollars in debt. But today, shares are surging 17% in the pre-market as the chipmaker completes its bankruptcy restructuring, slashing debt by 70% and cutting its annual interest costs by 60%. That gives the company a little bit of breathing room as it tries to refocus on its core semiconductor business. Meanwhile, we have shares of EchoStar also rising now 8% in the pre-market on our reporting that Verizon is the latest company to show interest in buying some of its wireless spectrum. AT&T and SpaceX have already bought and paid well above book value, so investors are hoping this is another payday for EchoStar. And we end on shares of Semtech. They are also rising 3.8% after Oppenheimer upgraded the stock to outperform, citing a big data center opportunity. Analysts there say that its active copper cables could start grabbing market share as soon as the next quarter, and they expect Alphabet to be a first major adopter. Oppenheimer setting a price target of $81, which represents about a 26% gain from these levels. John?
Yahara, thank you. Appreciate the update. More from Yahara in about an hour from now. On our radar this morning, the US moving closer to a government shutdown, with bipartisan talks at the White House ending without resolution. Democrats and Republicans blaming each other for the stalemate. Government funding set to expire at midnight tonight. Elsewhere, Delta Airlines CEO Ed Bastian expecting most US carriers to lose money this year. Bastian saying premium seats and a resurgence in business travel will drive most of Delta and United Airlines profits for 2025. And finally, the $55 billion leverage buyout of Electronic Arts, pushing global mergers and acquisitions activity above $1 trillion in the third quarter. A series of mega deals this summer, bringing back hopes of an M&A boom under the President, Donald Trump.
And if you were believing in that and looking at the leverage loan issuance and how it's at a record pace as well, Jefferies yesterday came out with earnings, which just put the hammer on the point, which was a record in terms of profitability because of this incredible rush of deals. So people have been saying there's a big pipeline, and we kind of raise an eyebrow each time. It seems like it is coming to fruition, and that this market is wide open. So anyone who's worried about easy financial conditions, it seems like, at least when it comes to M&A and debt deals, it's pretty wide open.
Wall Street Journal, a number of newspapers in the past few weeks were talking about, as well as this red-hot market of Wall Street banks basically poaching bankers. They're saying this is a red-hot market now. They want to pull the trigger, and they want to make sure they're ahead of this because they see this continuing under this presidency for the next 3.5 years.
This will be a major feature of the conversation with the banks when they report earnings in 2 weeks' time. JP Morgan, first of all, at the gate. That's going to be a topic of discussion in 2 weeks.
Yeah, how much are they ready to pull the trigger? How much are they going to follow Jefferies with record advisory revenues, given the fact that you are seeing companies truly engage? What sectors are driving this? Is it tech M&A that's going to be driving this? Is this media M&A? Is it being driven by necessity or opportunity because of the open markets right now? These are all questions to understand the longevity of it and whether it indicates really a revival in economic activity or just simply trying to execute when the window is marginally open.
The doors for financing are wide open right now, and there's a willing regulator down in Washington given a green light to do a little bit more.
Some of them. That's the question also. Which deals are going to be green-lighted and which ones aren't going to be green-lighted, and how much is that going to affect which deals go through? In other words, if you think that you're going to get a friendly Washington, D.C., well, you might as well pull the trigger. And if you think not, maybe wait a couple of years.
Let's talk about tech. Lisa mentioned it. Let's turn to it. The sector continues to drive markets higher, fueling fears of a bubble. Venu Krishna of Barclays saying AI fears are overblown. He writes, we remain constructive on AI, but even an upward path may not be without speed bumps. Venu joins us now for more. Venu, good morning.
Good morning.
You promised us a major research piece. You delivered it in the last week. Could the AI narrative stumble? My advice to everyone out there, reach out to the team at Barclays to get the full note. You're putting this out, that the data contradicts some of the ideas that have been pushed out there at the moment. The fears of overcapacity, oversupply. What are the data points that contradict those fears?
I think the biggest sort of concern in the market is, are we in some sort of a bubble, which is a legitimate concern because given the scale and the speed of capital deployment right now, that is astounding. And the problem is that the comparisons are to the dot-com era, which is 25 years ago. And so, what we did is undertook an exercise in comparing who are the biggest spenders right now, basically the hyperscalers. and then who was spending during that period, which was the major telcos, the biggest spenders. Of course, you also had smaller companies which were using the high yield market, the convertible bond market at that time, tapping. And there's a problem there because those companies which were tapping those markets in the telco space didn't have revenues. In fact, their revenue to debt ratio was 100 to 1, right? Debt to revenue ratio. But the ones who were spending, the larger companies, they were also increasing leverage. So their credit quality was deteriorating. And if you compare to what is happening right now, by a series of financial metrics, whether you look at spending relative to sales, or whether you look at the margin profile of companies who are spending, it's very, very different. Or the amount of leverage deployed, the leverage deployed right now is minuscule compared to that period of time. Now, operating expenses are increasing even for the big spenders right now. But what's interesting is because of the diversified businesses, their revenues are growing at a faster clip than their operating expenses. So our view is that this threat is something worth paying attention to. It is very important. But comparisons to certainly that bubble period is sort of, it's not the right comparison.
I'm pleased you bring this up because I struggle with the dot-com comparisons as well. I understand the need for a benchmark on Wall Street. You want something to compare to. But continuing to compare it to the most extreme period of valuations in arguably financial history, I'm not sure is a particularly useful exercise. What do you think is a credible threat to what is happening right now? What's a decent example of saying, OK, it's not that, but it could be problematic?
I think the credible threat is in the next, I would say, 12 to 18 months, this spending is intact because they have the capital, they're committed, and the race is on. But if you take a step back and based on the work we have done, there are some real constraints. For example, the power wall being hit. In other words, you can build all the data centers you want, but the power constraint is quite acute already. So that could be a problem. The second is, what if the models are no longer incrementally as powerful, like the GPT-5 wasn't as strong, as was only an incremental improvement. And what if the other efficiencies pick up in rest of compute such that you don't need as much compute power. So the demand wall can be hit as well. And third, of course, given the scale of spending, funding, right? Right now, finally, even though their operating cash flows are massive, and they're spending 50-50 on buybacks and capital spending, but they are turning to the debt capital markets as well to fund some of the DC growth, which means that as this keeps gaining momentum, that funding will become a bigger and bigger issue. And it's not an issue right now, but it could. So that's the reason why I think our main point is the theme is real, and in the near term, right, 18 months, we're in good shape. But it does not mean that you don't pay attention to what can go wrong, because a lot can go wrong. I would say that power wall is probably the biggest constraint, which can start reining in the amount of capital spend. And we've looked at the scenarios, right? What if capital spending goes down 20%, which, by the way, may not sound as huge, but when you compare it to the fact that consensus expects capital expenditure to increase 30% over the next 2 to 3 years, 20 is a big decline. What you find fascinatingly is that the earnings impact is relatively modest, call it about 3 to 4%. But the bigger impact, we think, comes on valuations. That could be a 10 to 13% impact. So when you combine that, we're talking about 15+% impact, even for a 20% decline in capital spending on AI over the next 2 years.
We're definitely going to be talking more about that energy constraint going forward, because it is something that we keep talking about. And Bloomberg put out a great piece talking about how globally data centers are expected to consume more than 4% of electricity worldwide, which would make it the fourth biggest in electricity use behind China, the U.S., and India. So definitely something to watch. I do wonder about everyone outside of the big magnificent 10, magnificent whatever number you want to put in there that are actually large enough. I love this quote from Warren Buffett: "Nothing sedates rationality like large doses of effortless money." This comes from Kevin Gordon, who highlighted it in a recent report. At what point are the other sort of smaller companies that are getting money thrown at them for just saying the word AI part of something that feels a little bit different than the very solid story you just told?
I think it's already spread. So one of the things we found in our work is that the AI exposure is really not so much about hyperscalers right now, because they have the financial wherewithal, but a good chunk, I would estimate roughly 20% of S&P companies or actually 1,500 if you look at, are benefiting. So these are in the energy, in the power, in parts of industrials, in parts of tech outside the big tech. So all of them, to varying extent, are benefiting from AI. But two things actually gives me a little bit of comfort. One is these companies are not including in their guidance the amount of AI-related revenue pickup quite substantially. In other words, the guidance is somewhat de-risked for these companies. So that is quite important. So, and if you look at the scale of revenues right now, the AI-related revenues are growing much faster, but at a much smaller component of their overall revenues. So from that standpoint, the risk is not that dramatic, even though it's there. Though I would say this, though, at the same time, what we have looked, the amount of euphoric behavior in the equity markets is extremely high right now. In fact, beginning of the year, our derivatives team created and launched a euphoria index in equities. And that has clearly been going up and up since the AI bubble, I wouldn't call it a bubble, spending picked up quite dramatically.
So just quickly, does that make you less optimistic for valuations, or does that mean you ride this euphoria for as long as you can?
I think you have to pick your spots. Riding it through the hyperscalers who have the capital wherewithal, whose valuations have actually come down, and who keep earning into their multiples, I still think is a safe way to do. Outside of that, there are enough names where the revenue, the earnings impact is minimal, but the valuation impact is quite high. You want to stay away from it. So one thing we are talking about is that because we do expect speed bumps, to buy protection outside the hyperscalers on this set of, call it 100 names which are exposed, buy where there's cheap puts to buy some hedging, because it's not going to be a linear path.
Venu, it's good to see you. Thanks for sharing this report with us. We appreciate it. Venu Krishna there of Barclays. We've talked lots about the amount of paper that's moved over the last month or so, how much debt has been issued. Take a listen to these numbers from the team here at Bloomberg. Investment grade and high yield note sales, respectively topping 200 billion and 50 billion for just the fifth month ever, with both markets logging their busiest ever Septembers. Leverage loan launches setting a quarterly record and about $4.5 billion shy of reaching 400 billion for the first time.
Yeah, you've seen all-in borrowing costs go down to something like 6.5% on average for all high-yield bond companies, and something well below that for investment grade at a time where the market's also wide open from the private credits funding. So this isn't just coming in the public markets where we can measure it, but beyond as well. With those markets wide open, people looking to put money to work, the golden age of income has to be made somewhere.
Or the golden age of issuing debt, at least for the month of September so
far. Go together.
Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over for Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Trump ordered 10% tariffs on imports of softwood, timber and lumber. Also, a 25% duty on kitchen cabinets, vanities and upholstered furniture. These tariffs set to apply from October 14th, though some increases are targeted to take effect next year. Trump said the planned actions aim to shore up domestic manufacturing. Charlie Javice has been sentenced to 7 years in prison and millions of dollars in restitution for defrauding JP Morgan. Javice was convicted in March for faking user data in a $175 million acquisition of her student finance startup named Frank. She remains free on bail during her appeal. Javice's lawyers and JP Morgan declined to comment on the sentence. The 2025 MLB postseason starts today with the best-of-3 wildcard series kicking things off. The New York Yankees will take on their longtime rivals, the Boston Red Sox, in Game 1 tonight at 6 p.m. Eastern, right here in New York. As for the Mets owner, Stephen Cohen, he issued an apology to fans yesterday after the Mets failed to reach the playoffs. That is your Bloomberg Brief. John.
Bonnie, thank you. Story construction, painful, isn't it?
I
it's
love
like Yankees
it.
this and then that line.
I love
As for
it.
the Mets.
I'm sorry, I'm hiding. I'm under the desk. I don't want to hear it. As for the Mets. Honestly, it's a travesty how much money they spent on that and the lack of show. And they
Stevie's apologised, hasn't he?
He did apologise. What's he
Okay.
supposed to do? Now what? I mean, honestly, it's like the curse
Do you
of the
accept
Mets.
his apology?
I mean, honestly, it was a painful night, and all I could say is, I mean, why are we spending more time on this?
Don't
Talk
worry,
about
we'll
your
move on.
Yankees. It's horrible.
Up next on the programme, the economy and the Mets at a crossroads.
We have weakness in the economy. The economy is on two very different paths. You've got a re-accelerating economy, and now you throw on rate cuts, which normally never happens.
That conversation up next with the CEO of Citizens Financial Group, Bruce Van Saun from New York City. You're watching Bloomberg TV. Equity futures on the S&P softer here by 0.1%. On the Nasdaq 100, we're down by 0.1%. Also on the Russell, negative by 0.3. Under surveillance this morning, the economy at a crossroads.
We have weakness in the economy. The economy is on two very different paths. Tariffs, of course, are eating into the lower-end consumer goods, into things like food and beverages that already have outstripped cumulatively inflation since COVID. Now you add on tariffs. It's a clear strain on the weaker part of the economy, and they need the rate cuts. You've got a re-accelerating economy, and now you throw on rate cuts, which normally never happens.
So here's the latest this morning. Wall Street waiting on a busy week of economic data. Investors looking for signals the US economy is heading back towards stable growth or volatility and higher inflation. Bruce Van Saun is the CEO of Citizens Financial Group, which serves approximately 6 million consumer and business customers. Bruce joins us now for more. Bruce, good morning. Good to see you.
Oh, great to be here.
Did we say happy anniversary? 12th anniversary?
Yeah, it's 12 years.
12 years has flown by. You've got a read on both the consumer and businesses as well. We talked a lot about corporate confidence, the M&A, the boom, things picking up. Consumer confidence still held back. What do you see across the business? A difference between the two?
I'd say we're in generally good shape. So I think everybody's still a little holding back because of the uncertainty around tariffs and some of the fiscal policies. But that's become the new normal. And so I think businesses now are leaning in a little more. And I'd say consumer is split. So the higher end consumer is still enjoying life, sees the stock market very strong, spending money. A little more pressure at the lower end. Inflation still is persistent, and real wage gains haven't fully covered that. So they're pulling in a little bit.
What opportunities are available to you and the team right now to lean into that higher end consumer just a little bit more, higher income, the private side of the business?
Yeah, so one of the moves that we made a couple of years back was we tried to buy all of First Republic. JPM ultimately was successful, but we hired a lot of the talent. A lot of the private bankers came over to Citizens. Hired 150 folks on day one, and then we've ramped that up now to close to 500 people. We're across $10 billion of deposits, and we're going to target at year end hitting $12 billion in deposits, $11 billion of AUM. So the business is basically exploding in terms of new customers coming onto the platform. I think we're delivering really good quality service at this point, and we're integrating that with our commercial bank. So a lot of our middle market companies are successful people. They have families in need of both business services on the commercial side and then individual banking and wealth services for the family and for the individuals. And so we bring that together to provide really robust solutions. And I think we're doing that better than anybody in the market these days.
Can you give a sense of just the rapid rate of growth and what you see over the next, say, couple of years in terms of that wealth management sector that's been driving growth or had been driving growth at a lot of the major banks?
Yeah. So one of the things we said is that by this year, that business would be 5% accretive to our bottom line. So it's basically a startup inside a 200-year-old bank. And so we had all the expenses day one, and now revenues are kind of exceeding those expenses, and we'll be well over 5% of the bottom line this year. You play that out 3 to 5 years, this business could be 15% of our bottom line. So anyway, we're kind of continuing to be finding the sweet spot between growing it at a nice clip, but growing it profitably. So one of the issues that First Republic had is their return on equity never got above 11%. We're running this business today between 20 and 25%. So we have good operating discipline on this thing. As we continue to grow, then we reinvest back in the businesses. We're opening up new regions. We opened Southern California. We're going to expand in Florida, put more teams here in New York. Tonight, in fact, we're opening our flagship private bank office on 52nd and 6th. So really exciting times and great initiatives that our team is executing very well on.
It's amazing how many points of contact you have to gauge consumer and business sentiment, as John was talking about. I just wonder, what is the sort of feeling, not just about investors, people who are trying to manage their wealth, is it risk on, is it risk off, right, but also the companies in terms of, are they moving past that waiting pattern, that holding pattern that we were talking about earlier this year?
Yeah, I'd say there's not fully leaning in yet, so we're not seeing our credit lines that we have out with companies really being taken down to invest in growth, in CapEx and things. But having said that, all of our businesses are having very strong years. So cash flow is good, businesses are solid, we see no real credit issues. I think with a little more certainty, they'd be leaning in more and they'd be doing more investing. So I think that's still to come. The good news is on the private equity side, on the kind of financial sponsor side, there's now a kind of tick up in deal flow, which we've been waiting for over 3 years to see that. And so our commercial bank has been positioned for this to happen. We've really invested in it. We've got great people. And so I think we're having a great quarter in terms of our capital markets revenues. The deal machine is going, the flywheel's going. So I think that'll continue. So that feels really good. So the corporate side has a little bit to catch up, but the financial sponsor side, that's ticking up very nicely.
You mentioned Florida. How much wealth have you seen move down from Florida? But you're still doubling down on New York. And I wonder if you're concerned about the mayor race.
Yeah, it's interesting. So we're focused big on 3 regions right now for growth. One is the New York Metro. So we bought HSBC's East Coast branches to get a foothold in New York. We bought Investors Banks, and we now have 200 branches in New York City. We've invested in middle market banking teams here, so we're really gaining market share in New York. The other 2 regions, one is Florida, as you mentioned, and one is California. So we now have over 300 people in both locations. And Florida has a lot of tailwind. During COVID, a lot of people moved down to Florida. That's continuing. And so we started with a private banking team in Florida, and now we've added middle market. So we have both corporate and private bank working together. That's a market where we don't have a lot of retail yet. So in New York, we have the full ground game with the retail. Florida, I say that we're coming in over the top of that market to really bank successful people. Same thing in California, over 300 people there coming in over the top. We have private banking teams, we have corporate banking teams, and seeing a lot of growth there as well.
Bruce, it's good to see you. Thanks for the update. Okay. Appreciate it. Thank you, sir. Bruce Van Saun there, the Citizens Financial Group CEO. I'm going to say this for Bruce, maybe a blessing in disguise not getting hold of First Republic, but getting hold of the talent instead.
He didn't have to pay the price, but he got the business, and that seems to be playing out.
Up next on the programme, Julie Biel of Kayne Anderson Rudnick, Jason Bazinet of Citi, David Seif of Nomura, Mark Haefele of UBS from New York City. The third hour of Bloomberg Surveillance. Up next.
The market continues to make new highs.
Higher productivity supports higher valuations.
The market clearly is pricing in a decent amount of expectation for forward growth.
Let's not just focus on the expectations, but also about the market action.
You need to put your money somewhere. And the reality is the US is the only place where you can actually put scale.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
I'm going to say this about 10 times in the next 24 hours. I cannot believe Q4 is literally around the corner. 3 more months to go for 2025. 6 months since Liberation Day. Where has that time gone? From New York City this morning, good morning. The third hour of Bloomberg Surveillance starts right now with equity futures on the S&P negative by 0.2% on the S&P. On the Nasdaq, we're down by 1/10. On the Russell, we're down by 1/3. In the bond market, 2s, 10s, 30s look like this. Your 2-year bond yield down a basis point. Likewise on 10s, 4.1290 on a 10-year maturity. And a week ahead looks like this too. It's full of economic data. Even if we don't get payrolls, we'll get a whole lot more. ISMs, PMIs, jobs coming up a little bit later this morning.
Yeah, you framed this really well. Everything has changed, nothing has changed heading into the fourth quarter, given the fact, I can't even believe it is fourth quarter, given the fact that the economic data is still a Rorschach test. You're still seeing the sort of, is this an economy that's reaccelerating, or is this an economy that really needs accommodation? The data is going to be key because ultimately we are not going to get probably a lot of the key points that the Fed looks at. So ADP, jolts later this morning. ISM manufacturing, how much will that really provide the temperature that the Fed has to work with?
I think a thing for us over the last month is this market has moved on. It's looking ahead to 2026 and has done throughout the whole of the summer. It's looking for a re-acceleration, believing that the worst of the data is behind us. And I think you're starting to see that. Companies have moved on too. I mentioned April, 6 months since Liberation Day. Do you remember that line from Jim Zelter of Apollo? Macro paralysis? That's no longer the story for corporate America. You see that in mergers and acquisitions. We've talked about the leveraged buyout of yesterday. You see it in the debt issuance, high yield, investment grade, leveraged loan. Companies are financing themselves, they're investing in things, they're moving on.
Yeah, and Jefferies, which came out and usually is a bellwether for the investment banking sector, came out yesterday with an unprecedented revenue for their advisory business because of that mergers and acquisitions activity. It is clear that companies have more confidence. Whether consumers also reflect that confidence in being able to absorb what will inevitably be higher prices this Christmas shopping season, that's the key. And even CEOs are not sure of that. And this goes to the question of, is the Fed looking at the same economy that is driving the profitability and the success of a lot of these companies? Or they're two different economies that are kind of moving in very different speeds.
And what we saw in the first half of the year is this pull forward effect. Companies might not be able to do that anymore. At the same time, the actual tariff impact might actually start to hit them. And the president continues to levy some of these penalties, as we saw overnight, and we heard from Kellyanne Shaw, there's going to be a dozen more when it comes to sector Pacific. And next year, they're going to have to figure out how to either diversify their supply chain even more or push more of this cost onto the consumer.
That's a process, not a one-off event, and that process is ongoing. I'm with you though, Bramo. The risk that this does start to bite. I mentioned Nathan Sheets of Citi. He's talked about it too, that it will start to bite into year end, that you will start to see those higher prices. You will start to see those changes.
Yeah, how offsides is this market to the idea of an earnings report that comes out and shows that either companies are not absorbing the prices, that you're seeing the hits to the margins in order to offset that, or that some of the demand is falling off in select areas? Not to mention an AI giant coming out and saying orders aren't as robust and then the moon's going to fall.
Then it's all over.
Yeah, then basically you're going to see this massive... And we're going to come here and say, I'm sorry.
With the sound effects. Hey?
Something like that.
The best counterpoint right now, I think, comes from Neil Dutta on all of this. I understand all the enthusiasm. I'm right there with you. I hope things get better for 2026. Neil's point is, if companies really believe in that right now, where's the hiring? That's why the jobs report's so key this week.
Yeah, the one caveat to that, and this is what a lot of people have raised, including some Fed officials, you don't understand, or we don't understand, the total ramification of artificial intelligence and how much that is acting in lieu of, say, a new hire that could potentially go through your lists, maybe go through your schedule. I mean, you can get an AI assistant to do that. So how much is that factoring in? How much is this that companies really just are not expanding? It's probably something of both of them. That's my guess.
I think the Fed chair also, if he doesn't know where the break-even rate is for the labour market, then how does he know what is a good and a bad jobs number? And I think we're all wrestling with that into Friday.
Yeah, I think that no one has any answers, which is the reason why you just see steady yields, because why vary from something when you have absolutely no conviction?
And equities keep riding higher for another month. Lower this morning by 0.2%. This morning, this hour, we'll catch up with Judy Biel of Kayne, Rudnick as stocks trade near all-time highs. Jason Bazinet of Citi, as he calls the timing of the EA buyout surprising. And David Seif of Nomura, as investors await a fresh round of payroll data later this week. We begin this hour with stocks on track for 5 straight months of gains as we close out September. Judy Biel of Kayne, Rudnick writing the following. The strength of earnings, even outside tech, tells us the ingenuity and resilience of corporate America remains strong. And that's great for the long term. Judy joins us now for more. Judy, welcome back to the programme. Should we just stick with what's working? Because what's working is working well.
I think that what's working in terms of what's actually delivering earnings growth should probably continue to do that. I think companies where you see a lot of speculation that AI is going to be able to reflate and really create a lot of business for them, that still feels very speculative to me. You know, I think we talk about, yes, we're in the age of AI. Why am I still filling out paperwork when I go to the doctor's office, right? Why is Outlook still completely unable to pull up any email that I request? I think there's still a lot of just regular innovation that still needs to parse through the system. I agree that AI is going to be transformational, but the way that it actually filters through our economy is limited by us as human beings to adapt. And at least for me, that's not always great, to be honest.
I can't short your doctor's office, so can you tell me what's publicly traded, where that pockets of speculative fervour actually are at the moment?
I think you see it in some of the small cap names, some of the crypto names. It still remains to be seen how these business models are really going to make money over the long term, especially when we're talking about an asset that's as speculative as crypto. So I think that there are places, even in the power generation side, where, those businesses are still utilities. They still are governed and regulated, and it's not easy for me to see how they're going to suddenly be able to generate the capacity profitably without it negatively impacting us as ratepayers. So there are pockets kind of throughout that I think we can really see there's too much speculation and the valuation has run too fast.
What's the trigger, Julie, to understand that maybe markets will come to grips with what you're talking about, that maybe valuations have outpaced the capacity to adapt as quickly as some people are expecting?
I think that, any kind of tech transition that we have goes in fits and starts. I agree with your previous guest that the telecom boom is not necessarily the best way to compare this wave. However, what we did see in the telecom boom was a level of overbuilding before we really needed all of that capacity. That is something that I do think is relevant to today, that we are building the level of capacity that we are, and that corporations are still only in the experimental phase, just like I was in the experimental phase in college, right? Same idea. It takes time to really figure out who you are. But I think what's really relevant and needs to be understood is that we can still build ahead. We can still have a lot of capacity growth ahead, and AI can still be extremely relevant and existential. It just means that it's going to move in fits and starts. We can all agree that if there's any kind of hiccup in the mega cap, that's going to be problematic for the whole market. But I even think at the margin, with the marginal player, some of the, even let's say the service delivery models, some of the consulting firms, I think if you see weakness there, that's going to be an early indication that we're in the kind of air pocket of earnings that I would expect over a long 10-year cycle transition.
It seems like everyone who comes on the show, Julie, is incredibly bullish, at least for the medium term when it comes to equity performance, let alone the AI transition. Are you pushing back against that? Are you more bearish? Are you expressing this and actually selling some of those names? Or is it just marginally shifting some of the investments away from the highest flyers?
I think that you can continue to own mega cap tech because most of those businesses by themselves are just unregulated monopolies. AI is only helping Meta do better in terms of its ad sales. So to me, it makes sense to have an investment in that company, not even necessarily on the hope that their AI is going to be a massive business. I think they've already integrated it in a way that where they can generate a lot of real earnings, and that makes sense. Where it's more marginal, where it's more speculative, where you have had a really large gap in the multiple, that's the place where I would have the most hesitation because I just don't think the earnings durability is going to be there for the next 10 years. I think those businesses have great prospects over a 10-year horizon, but most investors don't have that kind of patience.
Julie, you talk about tariffs in your note, how they are a bridge, but is the foundation a good one? How are you thinking about the reciprocal country tariffs versus what we got overnight, which was more sectoral tariffs on the likes of lumber and kitchen cabinets?
Yeah, I think that there is more firm legal footing for the Trump administration to be doing some of these sectoral tariffs, even if IEEPA is completely ruled null and void by the Supreme Court, which is, I think, a 50-50 chance. There are stronger legal footings. There are three paths that the Trump administration can pursue for tariffs. I think that when you see the level of complexity that's being layered into our system, that creates its own kind of friction and difficulty in being able to pull back from those tariffs. And I think most economists would agree that creating a government that's overly levered and overly reliant on tariffs isn't a great thing, right? We know that there is a lot of deadweight loss when you introduce tariffs. So my concern is that we become really dependent on these because we saw with the Biden administration, they were unwilling to roll back the tariffs that the Trump administration first put in, but they criticized them well ahead of time.
So do companies need to think about these tariffs, that even if there was a changing of an administration 2028, that they are here to stay for the long haul?
That is my concern. My concern is that it's really hard when you are unwilling to do the hard work of rolling up your sleeves to pull back on entitlements or figure out how to get us on stronger financial footing. Are you really going to turn down huge chunks of revenue that have sort of already passed through the system and people have already adjusted to? I don't think so. I think it's hard to really walk away from some of that revenue, even if it economically makes more sense to do so for the long term.
Judy, appreciate your take as always. Julie Biel there of Kayne, Rudnick. That final point I think is an important one. The systemic risk, maybe that's too much. The financial risk associated with tariffs now, I think it's real. The fact of the matter is that this is a huge source of revenue for the government. I'm pleased you brought it up. And it's very unlikely to be repealed by successive governments because they're going to depend on it. And ultimately, we've heard from people in the bond market now who have said this was a bond negative story in April, who now believe it's a bond positive story 6 months later.
It's a bond positive story because of the revenue coming in. Is it a bond positive story because of how much it slows growth? That is a question that a lot of people are going to ask. And ultimately, we haven't seen that aspect of this, but that will matter more to the equity side of whether they wake up to tariffs as a negative or whether it's a positive and it brings business back, particularly for domestic producers.
Stocks are down this morning by just 0.2%. Let's take the opportunity to get you an update on news worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. The U.S. is likely headed for a government shutdown. Senate Republican Majority Leader John Thune said Democrats' refusal to approve a short-term spending bill amounts to hostage-taking. Democratic Senator Chuck Schumer said Democrats could settle for some of their priorities, such as extending subsidies for Affordable Care Act premiums. Spotify CEO Daniel Ek is stepping down after nearly 2 decades at the helm of the streaming giant. Ek, who founded the company in 2006, will transition to the role of executive chairman. Spotify's co-presidents, Alex Norström and Gustav Soderstrom, will become co-CEOs effective January 1st. The change comes after the company reported its full first year of profitability. And OPEC Plus is set to discuss fast-tracking its latest round of supply hikes. A delegate tells Bloomberg the hikes would happen in 3 monthly installments of about 500,000 barrels a day in a bid to recoup market share. Crude prices and oil stocks are moving lower on the news. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Crude down on Brent and WTI this morning. Up next on the programme, the morning calls, plus Jason Bazinet of Citi as he calls the timing of the EA buyout surprising. That's next. You're watching Bloomberg TV. Stocks are negative by 0.2% on the S&P. Likewise on the Nasdaq 100. The open and bell about 1 hour, 13 minutes away. That's the price action. Let's get you some morning calls. First up, Needham raising its price target on Robinhood to 145, calling it the most advanced among financial services platforms. It's the biggest winner on the S&P so far for 25. This morning, we're down by 0.9%. Your second call from Mizuho initiating coverage on Meta. An outperform rating seeing the company as best positioned for AI. The stock is just about unchanged this morning. And finally, HSBC downgrading Electronic Arts to hold, saying going private is a net positive for competitor Take-Two. The stock is positive this morning by 0.1%. Let's stick with EA, the video game maker going private in the largest leverage buyout on record, valuing the company at $55 billion. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome to the show, buddy. You're going to have to explain this to me, not a gamer. What's Battlefield 6? Why is it so important?
Yeah, it's so important because the market's using the success of Battlefield 6, which is coming out October 10th, to justify the premium in this deal. You know, EA has been going sideways for quite a long time now, and it's not been able to free itself from the domain of video games like others have, right? If you think about Disney or Take-Two or whatever it may be, they have their core IP in video games, but they look to franchise into movies, television, and EA's talked quite a big game on that and never actually done it. You know, I find the comparison with Take-Two's opportunity here interesting, but really it's a deal where, like, look at the equity piece and what Saudi is doing anyway, bigger picture in video games, and then look at the debt piece and ask yourself, historically, LBOs are where the management sees writing on the wall that something's not going well for them or the industry. And I'm not sure which of those pull factors is king here.
Ed, what do you make of the characters involved in this? Krishna, the Saudis?
Yeah.
What do you think of the mix?
So I met with EA management like earlier in the summer, and we now know from the reporting that this deal was being discussed then in the spring, right? And the most important thing is Saudi is the biggest piece of this. They already had a 10% stake. They will end up with a big equity piece. Krishna's smaller, but Krishna plays a role in bringing parties together, right? The relationship between some of the Middle East-based LPs and the private equity arm of this. The debt component, JP Morgan, I think that's quite recent from what I'm hearing. But focus on Saudi. Like Saudi is the big player here.
Ed, appreciate your take and looking forward to the programme. A little bit later this morning, 11 a.m. Eastern Time, Bloomberg Technology with Ed Ludlow and Caroline Hyde. Joining us now, Jason Bazinet of Citi, remaining neutral on EA, calling the timing of the deal surprising. Jason, let's get to that. Why did you find the timing so surprising?
Well, I guess there's a couple layers to this. It wasn't like EA was out of favor or unloved by the street. I mean, things were going reasonably well for the firm. The valuation, I think, was quite reasonable before this offer. It was trading right on top of its 7-year average, about 19 times forward earnings. When we ran the math on what the returns might look like for the buyers using consensus estimates, we came out with sort of a low to mid single digit IRR. And so I don't quite get what's so compelling from the buyer's perspective. Usually when we see LBOs, we see a lean balance sheet like EA had, but usually there's some controversy there, something that's gone wrong with the company that sort of means the multiple is depressed and it gives opportunity for a sponsor to come in and buy the company. There was just no controversy here.
Is there any sort of growth path, Jason, that EA couldn't accomplish as remaining a public company?
I don't really think so. I mean, they had wide berth. I mean, there was a little bit of a controversy around this Battlefield 6 launch, which is coming out, as you just mentioned. That could help the multiple if EA can demonstrate that it's not just an excellent sports video game company, but a great video game company writ large. Because about a little over 50% of their revenues come from the big sports titles. And then they have this long list of sort of secondary and tertiary titles, Mass Effect, Battlefield, Apex, Sims, none of them really have busted through the way FC has or Madden. And so that's the opportunity. And maybe that's what the buyers see is the opportunity to sort of round out the portfolio with some other big franchises outside of sports.
Jason, if we zoom out a little bit, we keep talking about how there's this incredible M&A activity that has been percolating over the past few weeks and months. And I wonder how much of it is concentrated in the media space. If there is something specific driving this, whether it's AI, whether it's the risk of becoming obsolete, whether it's trying to consolidate revenue streams in an increasingly competitive landscape.
Well, there's two sort of vectors. I mean, if you think about other strategic suitors that might be interested in this asset, one vector would be anyone that owns a big cloud sort of infrastructure. Remember, Microsoft bought Activision a number of years ago. Many investors, and including me, thought that had to do with sort of a consumer-facing gaming subscription, where instead of buying a PlayStation or an Xbox, you just rent sort of your processing capacity from Microsoft Cloud and get with that some games. And so that may be what the sponsors are thinking, that they can flip this to another big cloud provider. The other vector is, firms like Netflix are moving into video games. There, the idea is to use the IP potentially to make movies or TV shows. I think this doesn't really score particularly well because the IP, the valuable IP that sits inside EA, are really those sports teams and leagues. And the rights that EA has don't really extend themselves to movies and TV shows. You'd have to go secure, separate rights from the NFL or, the European soccer leagues. It just doesn't make a lot of sense.
Well, whether it's clouds or maybe Netflix, do you see more consolidation in this space?
I do. But I would say that streaming video companies is probably more likely than I would say cloud, if I had to guess.
Jason, appreciate your time. Thanks for jumping on. Jason Bazinet there of Citi. Thank you, sir. On the latest takeout, go private, leverage buyout, biggest we've ever seen. Interesting mix of characters involved in this one.
Yeah, Saudi Arabia among them. This question of how much that money coming from that nation, that sovereign kingdom, has single-handedly boosted valuations across the sports landscape and even the derivatives, the games that are associated with sports. I wonder how much this is trying to consolidate their ownership and influence over just the West in general when it comes to sports.
And I'm sure we'll see a lot more because they want that clout in a way. But also Jared Kushner, who was at the, I wouldn't say press conference, press statements, because neither President Trump or Prime Minister Netanyahu actually took a single question, was at the peace agreement plan rollout yesterday press conference, just a day or the few hours after this was announced when it comes to what's going on in EA. So it is an interesting group of individuals behind this entire deal.
And what's your take on his involvement in this deal and his role putting together the money in the Middle East?
He's the bridge between, I think, Western investors and some of these companies and the big dollars in the kingdom and potentially even outside Saudi Arabia, across the Middle East. He has a tremendous amount of connections there. We saw those connections just grow after he left Trump 1.0.
Interesting to see his name alongside the Saudis yesterday following that record deal. If you are just joining us, welcome to the programme. Just a flavour of the price action for you. The opening bell about an hour and 6 minutes away. Equity futures slightly negative as we close out Q3 and the month of September, heading towards another month of gains on the S&P 500. This would make it month 5, the longest winning streak on a monthly basis going back to September of last year. On the Nasdaq, we're down about 0.1% this morning, but on the month, the Nasdaq 100 on the month is up about 5%. We've seen small caps outperform on the quarter, but on the month, we've seen tech start to regain that lead. All the headlines we've seen about various deals after deals, has really boosted these names that dominate the S&P and the Nasdaq 100.
The team over at Charles Schwab, Kevin Gordon, as well as others, have put together this theory that AI-driven stocks have gained 259% since the announcement of ChatGPT in November 2022. It gives you a sense of what is driving this. So, the way that you set this up, how much has changed and how much has stayed the same in terms of what narratives are driving this market, independent of any economic cycles.
The Nasdaq just about softer this morning by 0.1%. Coming up shortly, we'll catch up with David Seif of Nomura as investors await a fresh round of payroll data, a week full of economic data. Later on this morning, we get jolts at 10 a.m. Eastern time. Tomorrow, we're waiting for ADP and ISM manufacturing. Then on to Thursday, when we get jobless claims. And on Friday, we'll see if we get that payroll report. We'll have that discussion next on the programme. Plus, your morning movers. We're looking at Celsius rising after an upgrade from Morgan Stanley. That stock is up by 5%. Your morning movers up next. The opening bow is about 16 minutes away, so let's check in on the price action cross asset. We'll start with equities. Equity futures down by 0.1% on the S&P 500 following 2 days of gains. Looking to close out another month of gains. We're advancing for a 5th consecutive month on the S&P 500. On the Nasdaq this morning, up on the month by around 5%. On the session, we're down by around about 0.1% after big tech outperforms in a big way. Big headline just crossing, and I'm going to share it with you. CoreWeave inking a $14 billion Meta deal to supply computing power. We've seen a series of these headlines over the last month, and here's another one. With the latest, let's cross over to Bloomberg's Ed Ludlow. Ed, what have you got?
Yeah, $14 billion deal for CoreWeave is sizable. It's really understand what's happening here. CoreWeave is what we call Neo Cloud. It's data center capacity dedicated to either the training or running of AI models. And the story with Meta is exactly the same as it is with Microsoft or Microsoft on behalf of OpenAI. They don't have the capacity in their own clouds to handle all of the workloads relating to AI. And so they basically outsource and offload. The issue here, debt is playing a very big part in what CoreWeave is doing to move quickly to build out the infrastructure. They are supply constrained, and that's probably a massive understatement. So while they're onboarding all of these new deals, remember it was only last week that they expanded their relationship with OpenAI beyond $20 billion worth of capacity. They're in a situation where if they have 100 units of compute, they're having to decide which customer to give it to. So the headline is severe. It will likely push CoreWeave to the upside throughout the day. But it's still something worth paying very close attention to. When will this come online? How are they going to choose whether Meta, Microsoft, or OpenAI gets first dibs on the capacity that does come online? And how much more financing are they going to have to do to be able to move quickly to build that infrastructure? But the headline speaks for itself. Big deal for CoreWeave. Meta, building infrastructure itself, also needs some help from a third party.
You mentioned that stock, CoreWeave, up by 7%. Ed, you talked about Microsoft. Can you frame for us just how dominant Microsoft is as a customer for CoreWeave?
Yes, basically single biggest. And it was just last week that CoreWeave CEO Michael Intrater was on the close with Romain and I, explaining that all of these deals that it is doing, expanding the direct relationship with OpenAI, this new Meta deal, which we kind of knew, honestly, John, was in the works, products, diversifies away from that. But again, it's like this curious situation, which is like you have all these servers running. They're already accounted for. They're already given to customers. And so these are future deals. Call it pipeline, call you what it will. But long-term, moving away from Microsoft is key.
And I just wonder who's running the economy in America right now, if it's Chairman Powell, Secretary Bessent, or Jensen Huang, or Mark Zuckerberg.
Yeah, I don't know how much you guys have been discussing circular financing.
Yeah.
And it also kind of goes back to what's happening in debt and M&A, right? But the circular financing issue is particularly prevalent in AI infrastructure. There's some immunity in the debt portions that go into infrastructure finance from the factors of the Fed. You know, it's a more direct market. But this would be the question, had we got the opportunity to ask Jensen Huang, how much is this demand for NVIDIA artificially inflated by the fact that if you hand over $100 billion to a customer to then spend $100 billion on your own gear, I mean, that's circular financing, is it not?
Ed, thank you. Ed Ludlow there of Bloomberg. Again, look out for Ed in a few hours' time on Bloomberg Technology off the back of this deal. CoreWeave up by close to 8%. Meta just about positive. CoreWeave signing a deal to supply Meta with as much as $14.2 billion worth of computing power. That's the latest on tech. As we discuss that story, the President of the United States just engaging with reporters as we stare down the barrel of a government shutdown in this country.
And that's the first question a reporter asked. Is there going to be a shutdown? How many employees, government, federal workers will be laid off? And he said maybe a lot. So he's fielding these questions as we barrel towards that shutdown. Again, I repeat, it's not a matter of if, it's going to be how long. And this is going to be really important, obviously, for the financial community just when it comes to economic releases. And BLS is saying we're not going to get any.
We're not going to get any data. Payrolls, CPI in a few weeks' time. What are we going to do at the end of October when the chairman of the Federal Reserve sits around the table to talk about the economy?
They're going to talk about peripheral data, and they're going to say, let's cut rates. And that's essentially what people are expecting. And right now you're seeing the market respond with a wide opening financing market and everyone piling on the bet that right now this is an economy that's going to be run hot, and you might as well go along for the ride.
Let's go along for the ride and talk about what we might not get later this week with Reed Pickett of Bloomberg down in Washington, D.C. Reed, welcome to the program. We might not get payrolls on Friday. What will we get in between?
Yes. So what we know, in terms of a government shutdown is, how long it is really what matters here. If it's a couple days, then it matters very differently than if it's a couple weeks. So when we're looking ahead, we know from BLS has told us that they will stop data collection, they will stop releasing economic reports, that there will likely be delays with the reports if there is a government shutdown. So if there is a government shutdown on Friday, likely to not get that jobs report. And when we're thinking about what we will get stuff from the private data producers. So not only will we get JOLTS today, which is from the government while the government is still open, but we'll also get reports like ADP. Also, we've seen some data service providers like Revelio Labs come out with their own kind of payroll estimates as well. So it'll be looking at those types of data sets to get a sense of where the labor market is right now. But looking forward, we have to think a lot about data collection too. So if a shutdown extends for several weeks, that will impact the collection of data for key releases like CPI. It could also impact the collection of data for the next jobs report. So it's not just when we'll get this data, it's also the quality of the data going forward.
Reed, appreciate the update. It's good to see you. Reed Pickett there of Bloomberg down in Washington, D.C. With us around the table here in New York, David Seif of Nomura. David, good morning.
Good morning.
Good to see you. Let's talk about this. We've collected the data, haven't we, the payrolls? Isn't this just a case of putting it out there now?
It does seem like the heavy lifting on this report is probably all done at this point, and that it is a matter of choosing whether or not to post it or not. There may be some peripheral stuff that needs to happen that we don't know about, formatting the press release. I mean, little things like that, but things that actually have to happen. Does there need to be, beyond somebody just hitting enter to post it, a backup tech person there just in case, as has happened a couple of times over the past couple of years, the BLS has some issues with that data being posted? All of these things lead us to think that probably this report is not coming out on Friday, and it's certainly why we think the BLS said that all data collection will cease. This also is in keeping with the 2013 shutdown, which was just a couple of days before that October 2013 labor report was due to come out, and they didn't post that one either.
Well, there's a question not only of whether we get the labor market report, but how long a government shutdown could go on, and whether the Fed will have any government data additional to what they had during the last Fed meeting at their one at the end of this month, or at the end of October. I'm already shifting ahead. At the end of October, what's your view of how much that could influence the decision-making deliberation at the Federal Reserve?
Yeah. The less data that come out, the less of a reason the Fed would have to deviate from the dot plot, meaning the more likely it is that they will cut exactly 25 basis points in October, which is what the dot plot indicates. So it's our view that will happen at whether or not they get the data. But the less data that come out, I mean, what would the justification be for saying just 6 weeks ago we implied that we would be cutting 25 basis points in October? We have a lot less new information than we had expected to have at this point had the government stayed open. Hard to really say that they won't go ahead and carry out what they had signaled in mid-September under that situation.
Does that make you nervous, the fact that they are going to be cutting rates most likely at a time where we don't have the data necessarily, but we do have the data from markets showing a pretty euphoric feeling in markets, really wide opening financing conditions, leverage being baked into the AI trade in a new way? Doesn't that sort of give you pause?
Well, I would say that there was a somewhat of an incongruity between the SEP dot plot and the economic projections. Every economic projection that the Fed changed in September was something that should lead it to be more hawkish. Higher growth, lower unemployment, higher inflation. That's how they changed it versus June. And yet that was coupled with them saying, actually, we're going to cut more than before. We understand why they said that. There are fears about the labor market, et cetera. But the weakness in non-farm payrolls has been somewhat of an outlier compared to almost all of the other data, including in the past 2 weeks, where we've seen beats in industrial production, durable goods, retail sales, lower than expected jobless claims. So all of these things make it seem like Q3 ended up in a much stronger position than had been thought. At Nomura, our tracking estimate was just 1.4% 2 weeks ago for Q3 GDP, and now it's up to 3.0%. And so more than a doubling of our tracking estimate in terms of growth on the back of the strength of the data in the past couple of weeks.
When Jay Powell, though, gets up and briefs the press at the next Fed meeting, if we don't get these economic reports, this is someone who continuously likes to say we're data dependent. What's he going to say? Well,
he's not going to be able to say that they had any data to make this decision. I mean, that's the first thing, of course. But I think there was a bit of a tone shift in Powell at the last press conference. Data dependence is a sort of a buzz phrase that is always gets used. But this was actually the biggest break from data dependence, perhaps in many years that we've seen from the Fed, in that they basically came out and said, yeah, the labor market data has lost momentum. But generally speaking, we feel good enough about the data over the past 3 months that we're upgrading our forecasts. And yet, despite that data, we're going to be cutting more.
Is the Myron effect?
Really doesn't seem like it was. I mean, Steve Myron had been on the Fed for about 1 hour at the time that the meeting started. So it does seem as though perhaps the other doves, Waller and Bowman being chief among them, who did not dissent, may have, in what is very typical for the Fed, especially prior to a few months ago, said, okay, we'll get on board with this with this vote, with this decision, in exchange for a bit of a dovish pivot. And there's nothing nefarious about that. That's how actually the Fed has much more typically operated. Try to get a consensus. Myron wasn't there yet, so he wasn't able to participate in those sort of pre-meeting discussions. But it does seem as though they may have had some effect on that.
And this is what markets are loving, the fact that you've got GDP tracked at 3, and you've got a Federal Reserve promising more rate cuts, not less.
This is the reason why everybody's bullish. This is the reason why the M&A pipeline is getting absolutely spewed all over Wall Street. That's the reason why you can stomach debt to finance some of these AI hopes and dreams. I mean, really, this is the new territory that we've been breaching over the past couple of months, which is it all had been done by cash. Now it's being done on leverage because guess what? They can. And if there is the demand for it, people will create the paper for them. And that is definitely what's happening.
David, just finally, is this on their dashboard? What's happening in financial markets?
There's no doubt that
Does it matter?
There's no doubt that they see it. It certainly is hawkish compared to the stock market falling off a cliff. But again, it seems like it's not winning the day with them. And despite the strong economic data, maybe ex NFP, and despite what appears to be easing financial conditions and a steadily increasing equity market, they're going to cut 2 more times this year, and we think once more while Powell is still chair of the Fed.
David, it's good to see you. We'll talk about a post-Powell world next time you're back. David
Sounds
Seif
great.
of Nomura. Thank you, sir. Appreciate it. Let's get you an update on news worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. CoreWeave rising on news of a $14 billion deal to supply computing power to Meta. The deal helping diversify CoreWeave's business away from Microsoft, which has historically been its largest customer. CoreWeave will provide Meta access to NVIDIA's latest GB300 systems as part of the agreement. President Trump ordered 10% tariffs on imports of softwood timber and lumber. Also, a 25% duty on kitchen cabinets, vanities, and upholstered furniture. The tariffs, most of them are set to apply from October 14th. Some increases targeted to take effect next year. Trump said the planned actions aim to shore up domestic manufacturing. Exxon is planning to cut about 2,000 jobs globally as part of its long-term restructuring plan. The reductions account for 3 to 4% of its workforce or thereabouts. Other major oil companies include BP, Chevron. They've also recently announced cuts as crude prices fell this year. And that is your Bloomberg Brief. John.
Bonnie, thank you. Appreciate it. Thank you very much. Up next on the programme, Mark Haefele of UBS Global Wealth Management. Plus, we'll get those morning movers with your hire at CoreWeave. Shares are surging on the back of that Meta deal. That stock is up by 8%.
The biggest sort of concern in the market is, are we in some sort of a bubble? The problem is that the comparisons are to the dot-com era. It's not the right comparison. The theme is real, and in the near term, right, 18 months, we're in good shape. But it does not mean that you don't pay attention to what can go wrong, because a lot can go wrong. I would say the power wall is probably the biggest constraint.
Venu Krishna of Barclays there, just absolutely fantastic a little bit earlier this morning on the constraints around AI. Let's talk about the societal blowback, the pushback you could see, the political tension in the next 12 months. Electricity bills in this country, in certain pockets of this country, absolutely surging.
They're hitting records in parts of Texas. Obviously, Texas is big energy when it comes to wind, electricity, oil, gas. And this is where people want to build. These companies want to build some of these data centers. You have some individuals who are predicting that the energy demand is going to be the biggest since the United States started using air conditioners in 1960s. So this is going to have a ton of political blowback because people are just seeing higher electricity prices. And for what? Are there even more jobs being offered because of AI? So where's the win-win here?
The opening bound is about 42 minutes away. This is a main focus going into the open, with one name in particular getting our attention. Futures just about unchanged with your morning movers. Here's Yahira. Hey, Yahira.
Hi, John. We start with that one name, and it is CoreWeave, jumping 8% after the cloud computing company signed a deal to supply Meta with up to $14.2 billion in AI computing power. The CEO saying that Meta loved their infrastructure so much that it is coming back for more. And as Vonnie mentioned earlier, this helps CoreWeave diversify away from its largest customer, Microsoft. The stock has had quite the run since it IPO'd back in March, more than tripling in value since then. Meanwhile, we move on to Firefly Aerospace. Those shares are moving to the downside, down 11.5% after the company said that one of its rockets that was meant to launch in the coming weeks was destroyed yesterday during a test. This is the latest mishap for the company, which had another incident back in April. And Firefly only went public back in August, so it is still trying to prove that it can keep up in the ultra-competitive commercial launch market. And we end with shares of Celsius. They are rising 4.4% after Morgan Stanley upgraded the stock to overweight, citing stronger than expected top-line growth due to higher prices in the overall energy drink market and higher demand. And investors have taken notice, with the stock up more than 100% so far this year. John?
What a move. Yahara, thank you. Thanks to Annmarie as well, I guess.
Once in a while.
For that move.
Once in a while.
Okay, all right. Let's turn back to today's big story. Investors bracing for a potential government shutdown to begin at midnight. Mark Haefele, the Chief Investment Officer at UBS Global Wealth Management, writing the following. With the direct impact of a government shutdown on financial markets likely to be muted, we maintain a positive outlook for US equities. Mark joins us now for more. Mark, welcome back. It's been too long, my friend. Let's talk about what's anchoring that view. What's making you bullish right now?
Well, I think we've had continued strong earnings. We've seen this continued investment on the AI side. And then we have the Fed cutting rates. So those are positive backdrops. Would also add in there, the strong fiscal spend that continues, and that's been supporting the economic picture as well.
Mark, I know that these are real numbers, real revenue, real profits. There's been some concerns recently about circular finance, financial engineering. Do you see any pockets of speculative behavior that concern you and the team?
Absolutely, that there is, and there has been for several years, speculation in various parts of the market. I think a focus on quality is something that we have maintained and will continue to maintain, a focus on cash flows. There are plenty of stocks. It does seem like, you could put .com in your name and your stock would go up. Now you put AI in your name and your stock would go up. That kind of thing is a worrisome sign to a degree, and that's why you really do have to start digging in on, particularly, I think, on the cash flow side.
Mark, until now, a lot of the money that's gone into tech investment has been cash flow, free cash flow. Now we're starting to see more leverage get introduced to more of these deals. I'm thinking of the CoreWeave deal right now that we announced this morning with Meta. CoreWeave is a below investment grade rated company that relies heavily on the debt market, and this comes along with a slew of LBOs and other deal activity. Does that raise concerns about the debt side of the financing structure heading into a really uncertain economic time?
Well, I think it's a good point. As you've noted, I think rightly, we're starting to see really just kind of the beginnings maybe of some of the more excitement on the institutional side about IPOs and other things. So, I think some of this financing is absolutely something to watch, but we still believe, some of it around some of the core of the hyperscalers, that's still very early. But there's no question that there are pockets of leverage as well building up in the system. I think, the way we look at it overall with the AI project, it's something that we think is one of the longer term themes that we want to stay invested in, because we do see the productivity growth. We hear it from our clients who are customers. It's something they're investing in. We still like the power and resources story associated with that. We still like the healthcare story. These are areas, they're big problems for governments, and where there's big problems, there's big money going in. We've seen the president of the United States say, we're going to win it. We must win on AI. These are existential, ultimately defense issues, both for companies and for nations. And so I think that gives it something of a little bit of a different quality. And those are the kind of longer term trends we want to be behind, even if there is certainly the potential for some choppy trading into the end of the year.
Mark, if you do have all of this investment, the IPOs, the deals activity, can you get a real acceleration in growth heading into the fourth quarter without a reacceleration in inflation?
Look, we think there might be some acceleration of inflation. I think it's something about how much the Fed and other central banks would be willing to look through that. But also keep in mind, for if you take just the tech sector, that inflation is not necessarily an issue for them, because if you take the hyperscalers, they're not that reliant on debt financing, right? So there again, I think it could be a time to get a little more selective about who can continue to benefit, given the very large changes we've had in the way the economy has been moving forward this year.
Mark, I've got to squeeze this in. Got about 45 seconds. You're at UBS. I've got to ask you about gold. The move we've seen this year, this month, can you walk us through how investors are taking exposure to the precious metal, whether it's physical, paper, and if it is physical, whether they're choosing to store it closer to home?
All of the above, Jonathan. You should come visit the vault someday. Long equities and long gold has worked very well for us, and we think that will continue to work.
I'll come to the vault whenever you invite me, Mark. We'll make it happen. It's good to see you. Mark Haefele of UBS Global Wealth Management. Long gold, long equities. It's been a big trade, hasn't it?
I just wonder if in the gold room they have special lights that shine on them to kind of be dazzling. So you walk into the room and just have that moment. But yes, this has been the trade that keeps on giving at the same time as equity, which is an ironic and unusual combination when usually gold does better in bad economic times, not ones of prosperity.
What a time. It's our second invite to a vault, I think, in the last few months.
I could do a show at it.
Secretary Bessent said come down to Fort Knox.
Sort of, not really us. He said senators. I don't think he wants us, lurking around Fort Knox.
Quite a package, though, wouldn't it? Special programming, Bloomberg Originals, a tour
I'm
of Fort Knox.
I'm dying to go.
I'd watch that. Coming up on the programme, George Pollock of Signum Global, Adrienne Yee of Barclays, Michelle Weaver of Morgan Stanley, Vivek Arya of Bank of America. We'll see them tomorrow morning. From New York City, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.